So we've been speaking with Prakash Devan. We're going to have more guests. Prakash, I wanted to ask you about the Capex related stocks for the simple reason that yesterday we got the April-December numbers from the government.
Yes.
And Capex has really gone through the roof. They have spent 1,70,000 crore in 1 month compared to 50,000 crores in the last December. So April, December, now they are up 1.5% year on year. Till November, April-November, they were minus 12.5% year on year. So big cap. Government seems determined to spend its. Any thoughts?
So no, that's absolutely a very positive this thing, and that's what I was saying. You need to look at which are the sectors that will finally get most of the benefit percolating. But we have started looking at playing the Capex theme by buying into logistics businesses. Okay. So it's like if you generate more power, you need to evacuate. If you manufacture more, you need to move the goods somewhere, right? And our infrastructure on logistics is fairly dated. It's not the best in class yet. So ports, 3P package, 3P warehousing, all of those are themes that will start looking up. The number of companies, the kind of companies that's a bit smallish, you really don't have. The moment you talk about logistics, you go to a Concor or you will go to a TCI, but then there's lots more if you dig harder. So that's where you need to look at.
It's interesting, Prakash, you say that. By the way, I just want to point out that we've started getting some of the pre-open rates are trickling in, 70 to 80 points higher on the Nifty. That's how it's looking right now. The reaction on IndusInd is negative in the pre-open. Like I've been saying, while we all knew they have an MFI problem, but now it's really showing up in the numbers, in the slippages, which are higher, in the credit cost that's higher. So let's see. It'll probably settle down. We'll wait for this because Abhishek was telling us that while the numbers are bad, maybe not as bad as the market was fearing. So let's wait on this. But Prakash, on Capex, while I understand your point on playing it via the logistics players, what about the bigger companies? The Siemens, ABBs of the world, I mean Hitachi with their HVDC, or look how they've done. Now, I know the argument against these companies was that they were all trading at 100 PE.
Valuations,
Some of that is corrected, but is it enough?
I don't think it's enough. Because you've already penciled in the growth, and they will have to grow to justify these valuations. So, the market tends to kind of discount things in exuberance. And some of the businesses I was looking at are probably discounting 2047, the Viksit Bharat numbers as well. So, which is far-fetched, but you'll have to be cautious. But you have areas like pharma and, agri, cement. Those will probably attract more attention based on how people interpret the announcements as we hear them.
Okay. All right, let's actually throw it across to our colleague Shireen, who is joining in from Delhi to lead the coverage from Budget headquarters in Delhi. Shireen, good morning.
Good morning, guys. Of course, we're just counting down to the Finance Minister's speech. This is going to be her 8th budget, record-breaking number there being delivered by Finance Minister Nirmala Sitharaman. And, we've been talking about expectations and wish lists and all of that. I think the mood here in Delhi, and this is what all of our colleagues are also picking up, is that the message is very clear. It should be seen as a do-no-harm budget. Now, how feel-good will it be is the question, but no controversy. Don't want any kind of negativity attached to the budget. So a do-no-harm budget is certainly what the government is going in with as an approach at this point in time. Relief for the taxpayers, that's the number one ask. But again, I go back to, just the economic survey as well as the comments that came in from the economic advisor last night saying, look, it's not mutually consistent to continue to ask government to do the heavy lifting on Capex and then also expect them to do significant tax cuts. It doesn't work like that. There is limited fiscal space and limited fiscal room. The government so far has always prioritized Capex, has always prioritized infrastructure development and investment, and the baton now needs to shift to the private sector to start to lift on investment, wage growth, and so on and so forth. So we'll have to see whether there is any change as far as prioritization is concerned. I would imagine that there will be sweeteners on the tax front for the middle class. That has been something that's been talked about, and perhaps this budget will deliver. But how significant will all of that be is the question. And even on Capex, overnight we saw the numbers come in. 6.85 lakh crore rupees is the actual spend. It has been been an improvement, and that's what the government was hoping, that as the year progresses, there will be a pickup in spending. So, whether we're going to see a significantly higher number or not, again, let's temper our expectations on that, and we'll also have to see what the number is versus B2B and RE2BE as well. So those will be some things to watch out for. On disinvestment, and I heard many guests talk about that. Look, we've not just undershot the target, we've been nowhere close to the disinvestment target as far as the last many budgets are concerned. And I think increasingly the feeling is that there is limited appetite for significant disinvestment or even privatization. Even stuff like IDBI Bank so far, which has been on the list for the last 10 years, and that process of EOI and bids and all of that has gone through. We're still awaiting a decision on that. So I'm not sure whether there is really any appetite, and we should sort of have in store a big number as far as disinvestment, etc., is concerned. So that's really the mood here. Do no harm. How much will it be feel good is the big question. But we'll get you all the industry leaders joining us here at the CNBC-TV18 Budget Headquarters with the Confederation of Indian Industry through the day. Let me go across now to Nigel and Mangalam live at the National Stock Exchange as CNBC-TV18 rings the budget bell. Nigel, Mangalam, over to you.
Well, what a day it is, right? We're calling it a Super Saturday. We're calling it the day where we seize the moment, and that's exactly what the hope is out there as well. We're here at the NSE on a special trading session for the budget with special people as well. We have the man himself. Sir, what are your expectations from the budget? Because the stock market wants no change from a tax standpoint, be it the long-term capital gains, short-term capital gains, STT. They want some sort of relief. What are your expectations? Let's start with that.
In a way, running an exchange is basically providing the framework. The market's participants have their own perspectives. We as exchange have our own perspectives. And so we tend to work more on the developmental side, saying if the country grows, if the businesses grow, then naturally the markets will grow, and the taxes are more temporary in a way. So that's where we try to focus more on the developmental side and the growth side of the budget.
Definitely, but I'm sure that you would have some, desire for from the stock market standpoint.
No, the idea is to have more consistent approach which the government has taken over the last 10 years. And if you look at it the other way around, what are the sources of revenue for the government and what are the sources of expenditure? And literally GST is a situation where all the states have a veto. So GST is something the central government cannot do on the budget. What remains is only the income tax part of it. And that's where most of the time, last 10 years, you have seen some changes here and there. But again, because everyone has expectations in terms of the spend, that the social spend has to be there on the food, on Ayushman Bharat and many other things, as well as or infrastructure, and that's where the government will be sort of trying to juggle all these things, and we are pretty sanguine that if they are able to spend money on infrastructure, then naturally it increases India's ability to grow faster, and of course the markets will also benefit in the long run.
All right. Sir, this time capital market has been a big contributor to the tax kitty as well. Do you think this momentum to continue?
Of course, see, India is just growing. I think the growth has started. More people are participating, and so STDs and sort of a framework of capital gains tax also have come in over last few years. And I think put together, if India continues to grow, more people continue to participate.
STD number has already breached the expectations of this year. Do you expect any STD cut in this budget?
For me, the STT itself is so small, people don't even realize. And that's why I don't think there's going to be too much of tinkering with the STT part at all.
All right, but the markets will be hoping for some kind of a booster shot, so let's wait by for that. Gautam, let's come across to you. What's the crucial number you're looking at? We have been having this debate whether you're going to be focusing more on consumption or capital expenditure. What's the crucial number we should be tracking?
So the headline number will be fiscal consolidation, which will anyway be lower than what we have seen over the last 2 years, which is great.
What's the number that will keep you happy?
So our forecast is 40 basis point consolidation this year, which is lower than 80 basis point we saw for FY25, so it will be good. But I think more than the headline number, the mix of small schemes, packages, etc., whether it turns the sentiment both for consumers and corporates. That's what markets would look at.
Let's go across to...
Let me ask Nileshbha on the Capex front. Nileshbha, you expect Dhoni-like batting in the last 3 months to meet the Capex number?
Well, at least in December, the quantum increased and the quality increased. So let's hope that Dhoni spirit lives in the Capex and we achieve 11,11 crores auspicious number.
We did ask Ashish about what his expectation from a capital market standpoint is. He said that from the exchange standpoint, he wants the framework to continue. What does the market want according to you? I mean, what do you think the way the positioning is right now? Everyone's a little down on sentiment. What is it that can boost sentiment, turn things around? Not for the near term, mid term and long term, but just, the way things are right now.
So if we go by the meme industry, then they just don't want increase in taxes.
Okay.
If we go by real market expectation, they want Triveni Sangam. One, as Gautam mentioned, fiscal consolidation, deliver on the promise of 4.5%. Number two, go for Capex because private Capex is subdued.
Yeah.
Support urban consumption, especially as that has started slowing down a little. And finally, if you have to spend money and you have to maintain fiscal deficit, then you have to raise resources. Now, please don't tax people who are already in the net. Outside of tax nets, there are many big sharks. Go for them. And my wish list, which I don't know whether it will ever come, is raise resources through out-of-box thinking. For example, we always have believed that Western world does things right. In US and most Western world, there is exit tax. We have seen many rich Indians leaving India and settling down abroad. Why not tax them? Second, we all know how much gold Indians own. We don't even know probably how much gold Indians own. That's lying in our Tijori and safe deposit locker. It's a frozen savings. Why not do a gold monetization scheme which can bring those gold in Tijori to outside economy and provide growth capital for our entrepreneurs? The third thing, we have been managing our PSUs pretty well in last couple of years. But overall return on equity on PSUs, bearing few exceptions, is really poor. Should we copy someone like GIC, Temasek or Norges kind of sovereign wealth fund, which allows us to manage our PSU assets better, generate better return? So there are multiple ways outside of economic survey, outside of budget to raise resources, use those resources to fund Capex and other investments, and maintain the path of fiscal prudence. That will blow the market's mind.
Okay, all right, Nilesh, I thought, my imagination was going a little wilder since the SIP flows have been strong, the domestic money has been strong. Do something to, give a little further impetus because those FIs have been selling.
Nigel, what will be the happy return for you in SIP?
For me?
Yeah.
I'm going to keep it going.
What return, in your opinion, will be good?
It should be at least, in the mid-teens over a longer duration of time.
This correction, SIP returns are already in mid-teens.
Yeah, right. But I'm hoping that it sustains, right? I mean, and if I get more, I'll be even happier. But
see, if they present a budget like this, I can assure you that those returns will be sustained.
What will bring FIIs back? $30 billion sold over the last 4 months or so. What do you think will bring them back?
It's not about only the FII, but the FDI as well.
Yeah.
Anything in the budget that you expect that will draw a lot of FDI capital and FII capital?
So on the FDI side, I think the CE has done a fantastic job on ease of doing business. When your wage slip font is prescribed, when the swing of the door is prescribed, when maintenance of health record for the cook is necessary, all those things create an Inspector Raj. Now, you have to whitewash your wall, but what is the definition of whitewash? Who knows? So we have to improve ease of doing business from the current level. It's better than the past, but we still need to go ahead. If we improve ease of doing business, my feeling is that FDI will come back. Please remember that there is also FDI going out with people like Hyundai booking profit, LG booking profit, Whirlpool booking profit. So it's that experience that in India there is exit also. In most global market there is Chakravyu. You can enter, you can't go out. So FDI will come provided we can improve ease of doing business.
All right, I think we are about 20 seconds down to opening the market, ringing the bell here from NSE itself. So we just
it's a super Saturday and
let's
we're all
do a countdown as well.
9,
8, 7, 6, 5, 4, 3, 2, 1.
All right.
Okay, so it's
well,
a green start at least.
the bell has gone, and the bulls have spoken from NSE, and we had, I think, there's a image floating around on social media, which will, you'll see Mangalam and Nigel rub the bull's horns, and maybe for now that's really worked. About 26 points higher. The Bank Nifty is a little iffy. I just want to quickly check the reaction on IndusInd Bank to begin with. Right now, 1.2% on the upside. Even Sun Pharma, after the conference call, the commentary, everything, Sun Pharma is also on the upside. So, large caps looking good, but mid caps looking even better. 0.5% up on the mid cap index.
All right, let me just quickly run through a few more names, right? So, in terms of what's happening right now, because we must address that. Inox Wind is the big mover. And we discussed this in the morning. So 7.5% on Inox Wind. Vivek highlighted the numbers, looking very good. Stocks have seen big damage, along with Suzlon. Suzlon is up another 4.5%. So this is the renewable part in that sense. It's, I think, budget related. There's no other reason. RVNL, IRFC, Jupiter Wagon, Ircon, Railtel, Titagarh, BEML, these are all up between 2 and 5-6%, and these have all got huge volumes. There's no separate railway budget. You'll hear allocations, etc. in this budget, and there's been focus on spend on railway, so this is that, nothing else in that sense. Apart from that, Sun Pharma is up about 1%. It's starting small higher. Wockhardt ended 10% in the green yesterday. It's up another 3%. From the EMS space, you've got Keynes, which is up about 2.6 higher. Remember that electronic component PLI, 25,000 crores. So something we may hear from the budget today. There is Praj Industries, which is up about 2%. These are also potentially, right, ethanol, etc., government policy. Depending on government policy, budget play, we don't know. Kalyan Jewellers is the top volume traded loser. It's not down much at all. Yesterday was a repair. It was up 10% yesterday. It's down about 2%, starting up.
Gold duties
big volumes.
are expected?
Gold duties are expected, certainly. And Manisha has been telling us about that. UPL saw a big move after that guidance, which the market likes. Stocks are about 600, but again, over the years, big underperformer. ONGC is down 2. Bandhan Bank is down 0.75%. These are some of the top volume traded losers. EPAC Durables is down 5%. And I think Chola Finance is also reacting to numbers. It's down about 1.5-2% or so at this point. Hero MotoCorp, that CFO stepping away, 2% lower, 42.60 or so as far as Hero MotoCorp is concerned. There is Karnataka Bank, Aster DM, 5-star, but volumes are thin, so I wouldn't take too much. I think the market is absolutely flat. 5-point change is neither here nor there, and I think that's
what happens if you trade on Saturday.
It's the right way. But also it's the budget is, I think, the right way, right? You don't know what's going to happen, so go in absolutely light.
There's some red.
Unchanged.
Some red. Watch the banks. There's a little bit of red. Bank Nifty and Nifty for the time being.
Okay, Nilesh, thank you very much for joining us in our studio. Big day for us, and thank you for being with us. Well, how do we start? Do you think we should start buying in now? Because as I was telling one of our foreign guests, the rupee is cheap enough and stocks have fallen. And we have, that FII number started declining. Yesterday was only 1,800 crore. You think they're reaching some kind of an inflection point?
It looks like, Lata. Clearly, few things have happened. Most importantly, like what you said, the currency has become a lot more attractive from an investment point of view. Valuations have corrected quite meaningfully. The large caps have corrected 10 to 15% from the peak. Yes. It's been almost about 4 to 5 months of correction phase that the large caps have gone into. On the mid and small cap side, the correction has been as high as 30 to 40% in individual stocks and almost 20% at the indices levels. And clearly, there have been pockets of growth. It's not that we're looking at the headline numbers and low single-digit growth, but then there are enough number of companies in various sectors which have demonstrated very, very strong growth. So clearly believe that clearly the fundamentals are still intact and the valuations have become more compelling, more appealing.
By the way, just revisiting again more numbers, ONGC is the biggest loser on the Nifty right now, and that's a result reaction playing out. So Darshan earlier was telling us that Crude oil realizations have been on the lower side. So and there's, I think, lower other income, which is why the profit is also below estimates. So just keeping that on the radar. Nilesh, hi, great to have you with us on a Saturday today. I just want to get your sense on this FPI selling. And I know we've all been very brave and, as investors and as a country, we need to be. And domestic institutions have done a phenomenal job of absorbing the selling. But in your memory, do you remember a time like this where on a daily basis, usually it's in a pattern, it waves up and down, but it's been this one-way incessant fall. Do you see it changing at all unless there's a major crack on Wall Street? And if it continues in this manner, then what are we looking at, irrespective of the budget over the next couple of weeks and months?
Well, clearly, I think one of the challenges which they have faced is more around their home market doing extremely well. The US pretty much has been the best performing market, at least over the last 1 year. And then the views around the strengthening dollar, the weakening EM currencies, that's clearly been their very, very big focus area. And on top of that, valuations here, they look at it more from a historical perspective, that we're trading at premium valuations versus our historical averages. So that's been the second big factor. The third big factor is probably, I'm not entirely sure about this, but India is probably the only large market where foreigners have to pay tax. I think you as an individual, if you were to invest into the US market, you probably don't pay tax in the US, you pay tax in India.
Look, Americans have to pay tax for their market. I mean,
on your home market.
Foreigners.
Yeah.
10% tax across the board of the
US. If you as a foreigner invest in any major market across the world, you as a foreigner, you have to pay tax in India, not in that foreign market. Okay? So if you clearly see it, I think these are the three factors. One is your home market doing well. Two is the valuations. And third is, of course, the tax angle. These have been the three factors. Now, even if one or two out of this give way, which means either the tax gets reversed, the probability of that is extremely
let's not even
low.
Go there.
But if, let's assume, because of this correction, the valuations look a little more attractive or more reasonable, or if the home market,
the US market starts underperforming,
looks more expensive in context of the overall growth, that India earnings will grow in double digits, US earnings will grow in single digit, and therefore let's move to India. I think if any one of these three factors starts to play out, this trend can reverse.
But the question is, I don't know if you see it on the horizon anywhere or not. And if you don't, my question was, if that inflection point doesn't come anytime in the near future, then can a Capex announcement today, we were at 11.1 lakh crores, now let's say they say 12 lakh crores today. Can just an announcement like that from the budget revive market spirits?
It can. I think the first is do no harm. I think if that's the starting point, which means don't raise taxes. If at all, simplify taxes, rationalize taxes, maybe lower taxes. That's a good, useful starting point to have. After that, if the budget continues to be growth-oriented, there's a huge focus on Capex, on infrastructure. If there's a better capital allocation, the capital allocation which has been happening over all these years, if that gets accelerated even further, these could be good trigger points.
Absolutely. I think well put. First, to no harm. I think we'll live with that. And anything on top, of course, is cherry on the cake. Let's throw it back to our colleagues, Nimesh, Nigel, Mangalam at the NSC. They've got a stellar lineup there as well. Guys, over to you.
Well, thanks a lot for that, Prashant. Well, we have Bala as well, who joins us on the panel. Bala, thanks a lot for joining in. Well, tell us what's on your wish list. Budget 2025, nothing wrong in wishing, right? But if you could give us a couple of points on your wish list.
Of course, clearly, if you look at the last 3-4 years, I think you've done a great job in terms of ensuring the budget expectations are kept under control. And second, the fiscal focus, which has been the main focus for the government, and also improve the overall tax collections. I think you've done a great achievement so far. I think in this first year, probably we'll see the fiscal deficits will be a lot more under control. The government will have enough room actually for them to actually give away more in the hands of people. Therefore, my expectation in the budget is having seen good success in creating a great collections in GST, tax collections overall to GDP ratio has been improving, and the government Capex has also been going up each year to drive the economic growth. I think they'll have enough room actually to drive the consumption growth this year. I think probably more money in the hands of people, especially at a time where the last 2 months have been, almost six months have been quite tough the economic growth coming down, and the general consumption slowdown has been seen.
So you're saying a bigger focus on consumption is what you're looking for, and you believe that they have the headroom?
Correct. They will probably have more tax cut, especially for the middle class income people. So more money in the hands of people, therefore more money to spend, and therefore the consumption can be driven back. Okay. So that one big area of focus, I think my own belief will come.
Consumption
and second, consumption to boost. I'll also not be surprised if they take a bet in terms of capital gain tax cut, given the fact the last 2 years, despite increase in taxes, and the Indian equity market has done exceedingly well in providing the much needed capital for corporate growth. And given the fact that now today the need of the hour is actually to drive back the growth in the economy, there's a high probability when they may even consider some element of tweaking in the tax structures to ensure not only, of course, it boosts the capital market sentiment, it also boosts the whole ecosystems around the real estate.
So you're saying, so reduce it a little bit is what you're saying?
There is, I think, with last year.
Just calling for the sweets.
You just call for all of them because the bulls would definitely rejoice that.
But of course, I'll take a bet because I'll not be, of course, I'm willing to take a bet on that. Given the fact last year was a surprise increase of about 2.5%, which is not needed as such, given the fact that you have been quite compliant and tax ratios have been increasing, and the stock market has been helping actually for companies to raise capital to fund the growth. And that is being the case that people have understood the actually power of how Indian capital market can provide capital to the Indian economic growth. Given that fact, and also given the fact that FI has seen only outflow in the last 1 year, there is a high probability that they may take a bet in tweaking the capital gain tax in such a manner. It boosts actually sentiment.
Well, most on the street would be happy with no change whatsoever, but if you're saying that it is lower, then it will only be the added sweetener. Let's ask Gautam. Gautam, realistically, what can be done? Because yes, everyone's hoping for Capex to happen, consumption to be boosted, fiscal consolidation, all of that, realistically, what according to you is the expectation? And on fiscal consolidation itself, the next couple of years, yes, we do have that glide path. Thereafter, people are looking at newer ratios as well, perhaps something like a debt to GDP. What is your view on that? And you have an underweight rating on India in your EM basket. What do you think should happen in this budget for you to, twist that, maybe turn positive once again?
So look, the government has a lot of levers always, as Neeraj Bhai was earlier mentioning about some unique measures which the government can always look at, or innovative measures to get more revenues. But beyond that also, the good thing is none in the market is worried about fiscal slippage. Unlike few years back, that itself is a great start. That gives a lot of leeway for government to keep sentiment intact. But in the context of this budget where there's a lot of demand around consumption, around Capex, I think, look, ultimately government can't spend in a big way. But there are many small signals which the government can do. And what will be very relevant in my view from the market's perspective is if the entire package creates a feel-good and positive sentiment, both for the consumers and followed by corporate Capex activity. Like if you go back a year back, we saw some signals of private corporate Capex building up. Corporates were waiting for elections to get over. Post-elections, we haven't seen that come back yet. So any package, not necessarily in rupees or dollar terms, but at a broader package level, signals which revives this private corporate Capex sentiment, I think can go a long way to boost markets. Finally, your question around our EM strategist underweight stance on India. Look, that's a relative call in the context of the near-term valuations, everything. I think there's no debate, including among the global FIIs who have sold in the last few months, about the structural growth in India. Look, in the context of FIIs also, their holdings in India is $800 billion, roughly. They have sold $20-30 billion. So it's not that they are walking away. They're still here. They want to be here. It's a question of getting the right opportunities in terms of the right stocks, and therefore the budget sending the right signal can go a long way in getting the interest back from the FIIs.
All right, just a quick question with regard to that preference in the emerging markets. India is, not top of the pop. So who's, do you bring China? It's a valuation call that you're taking out there?
So right now it's an overweight China call. That's primarily related to the valuations there and some stabilization in the macro, not necessarily a big recovery, but stabilization in the macro. But primarily it's a valuation call. It's just an extremely undervalued market compared to history.
Well, that's an interesting point because everyone's talking about only the FI selling, but as a percentage of the market capitalization, actually it may not be that much. But the hope is that, in fact, they take their foot off the pedal a little bit with regard to the acceleration. Nilesh, let me get you into this. What's your take? If they let the fisc slip a little bit, not too much focus on the fisc, but maybe more measures to get the economy up and running. And to give, credit, the government spent, Capex spent, as you mentioned earlier, 1.7 lakh crore in the month of December was the highest. And that's why even year to date, now the spend in this fiscal year is more than last fiscal year. So that was good. And the RBI as well, they have realized there's a bit of a problem and there are measures being taken. So your take.
So one, as Gautam mentioned, right now market will be benevolent on the fiscal slippage. But please remember that our combined fiscal deficit between center and state is upwards of 7%. I don't think so we should go on the path of fiscal slippage.
Okay.
It's like putting burden on your next generation for your today. Which parents would like to do that? I'll rather leave asset for my daughter than the debt. So same thing should apply to the government. And yes, there are various levers in the hands of government. Few I talked there. One big is the divestment. Now government today owns about 10% of India's market cap. There are many unlisted segments within government. Why not we manage that well and raise resources? You have almost $500 billion worth of PSU holdings which are listed. A small monetization over there will give all the resources you need to fund your spending and yet maintain the path of fiscal prudence. Today, very few countries are progressing on the path of fiscal prudence. If we walk over there, many FPIs may change their view about us.
So gold monetization, that exit
tax,
clause, divestment, those are the three big measures.
Catch the sharks outside the tax net.
Or catch the sharks outside the tax net. Once again, on this out-of-box measures, etc., while we're still talking about job creation, skill development, we're talking about boosting manufacturing, Capex, all of that, the biggest underwave right now has been artificial intelligence. What's taking place in the world as well. We heard glimpses of that, read glimpses of that in the economic survey. Do you think the word AI will be a prominent, part of the finance minister's speech? Do you think the government, in light of what is happening right now, will maybe at least talk about that?
So undoubtedly they'll talk about it because it occupies such an important piece in the economic survey. And we have to follow the ISRO model on AI. We don't have resources like Western world. China has already shown, albeit with a little bit of magical numbers, that they could develop AI at $6 million. That probably is a wrong number, but certainly it's much lower than what Western world is spending. And we have done that in ISRO. Prior to 2014, we sent 35 satellites into the orbit. Post 2014, I think we have sent multiple numbers of that at a much lower cost. If we can do that on satellite, what stops us from doing it on artificial intelligence? If the foundation program of AI is ours, then people will pay us toll for using that highway. If we are using someone else's highway, we'll have to pay that toll. Forget the security risk, just the commercial sense. The return on investment on AI foundation will be far, far better.
You spoke about satellite. The only satellite that the street wants is, a boost in the sentiment, and as a result of it, there would be rockets in the market, hopefully, Nigel.
All right, well, Gautam, let me come across to you then. On the markets, on the Indian markets itself, from the emerging market basket, you're not very, very positive, But there'll be sectors and themes that you'll still like as well, right? From this budget perspective, what is the booster shot you're looking at for a couple of themes out there?
Look, there are enough pockets already emerging after market correction. Yes. Not necessarily at a sector level, but at a stock level. But industrials, pockets of consumer, not broad consumer. Financials already emerging attractive.
So the best of industrials is not over. There is still, after the recent correction, some of them are looking good.
Because look, if you look at industrials top down, what we have seen in the big cycle last couple of years has been driven by specific spending by government, defense, etc. We still haven't seen a big private corporate capex cycle happen. So industrials, in theory or in possibility, has a long runway. But the missing ingredient is the private corporate capex cycle, which is one of the things we'll watch out closely in this budget.
Right. Bala, your top picks, sectors?
Yeah, I think the way I see is, of course, budget is one part of it. And if you look at beyond the budget, we'll have still RBI monetary policy. We'll have to do a lot of stuff, especially with respect to the step that they have taken the last 1 year in terms of tightening the credit growth, as well as tightening the entire balance sheets of the banks and introducing new measures to control I think post-budget, I think depending upon how the fiscal numbers will be projected, the monetary policy will be more supportive of removing some of these tightness than last year to enable the growth back. Therefore, financial sectors, one, have come to the reasonable valuations. And second is, I think the spending that has been happening in India, especially in the government Capex, which is now picking up, you'll probably see all the sectors which actually been the large beneficiaries of the Capex growth, including energy sectors, will probably be another big sector to look for as we move forward.
All right, well, that's an extremely interesting conversation from the NSC, where we rang the bell on this important day. Finance Minister with the President of India and, of course, her team from the Finance Ministry as well. That's this ritual. The Finance Minister goes to the Rashtrapati Bhavan and, of course, then with the permission goes to present the budget to the Parliament. So that's
the law
essentially...
says, Prashant, the law says the President causes the budget to be laid.
Correct.
So it has to be.
Absolutely. Well, those are some sort of ceremonial shots coming through.
But correct me if I'm wrong, that this time we're getting more visuals from, inside Rashtrapati Bhavan and some of the North Block. Usually
I think so, Surabhi, because I don't remember these shots.
We've not seen this before. It was the customary, earlier the briefcase, then the red tablet, but outside North Block. This is interesting.
The women are in step with social media more.
Absolutely, and why not, right? So those are visuals, and we'll sort of keep on the visuals on the side of the screen as well. Let's get some corporate reactions now. Expectations more so, because the budget is still ahead of us, not behind us. Atul Lal is now joining us, Managing Director at Dixon Technologies. Is the leader in the EMS space by a long shot. Atul, good morning. Great to have you with us here. Thank you very much for your time. Prashant this side. It's essentially the poster child for what the government can do in terms of pushing an industry and really helping it start up from the scratch with those PLIs working their magic over the last many years. What should we expect this time around, Atul? There's that components PLI, which has been spoken about quite a bit. Your expectations?
So, Prashant, you're absolutely right. We in the industry are very keenly waiting for the component PLI to be rolled out. Hopefully, we'll hear something about it in the budget. Please appreciate that the electronics industry has been on a significant upswing. And the agenda of the government is to take it up from $150 billion to almost $500 billion in the next 6-7 years. And the first part of ensuring that all devices are being manufactured in India has already been achieved. The next is to enhance the value addition, expand the value addition, for which the component ecosystem is required. So we are keenly looking forward to the rollout of the PLI scheme for components, which is going to be essential in taking the industry forward. That's one bit. Second, of course, electronics manufacturing is a highly labor-intensive industry. So we expect something more because the Honorable Finance Minister had already rolled out some schemes. We require some structural strengthening of the schemes. We feel that there should be something on that line also, so that the employment creation is seamless. So these are the two things. And of course, there is some tweaking required in the indirect taxes so that the operation of the industry is much smoother. So electronics industry is on a high, and we are keenly looking forward to this budget on these three parameters.
Atul, just one clarification. The earlier PLI winds down. There is no concessional. The component is, of course, ahead of us, but the earlier PLI is now winding down. There's no expectation on that, right?
So 25-26 is the sunset year.
Right.
PLI scheme for mobile. However, the schemes for white goods and telecom devices carry on. There is still a significant part of tenure is still left. So we feel that there should be something more on the PLI for mobiles, because mobile has already emerged as the second largest export product in the country. And we need some kind of handholding more, because still this industry is in a status of infancy to take it forward, possibly with some more tweaks, but some more handholding is required beyond 26.
Mr. Lal, just to get further clarification, the new PLI scheme, which has recently been announced, which is for electronics, that covers components, or are you now saying that we need another additional new scheme, which will specifically cover components that go into electronics?
So we are waiting for the rollout of the electronic components PLI scheme. We understand it's going to be rolled out shortly. Basically, we are talking and referring here to non-semiconductor components. What government had earlier under ISM-1 was primarily focused on the semiconductor components. Yeah. So here we are talking about the non-semiconductor components, which form almost 50% of the bill of material of electronic devices. And that is essential in giving stability and also improving the cost structures in the industry.
Okay. And Mr. Lal, you're expecting that 15% concessional tax regime to be extended. You already have taken advantage of it.
Yeah, in many of our units, we are availing 15% tax regime. Yeah, because that's going to be again a big up, because we in the industry are having significant Capex investments, and we're expanding. We are setting up almost 2 to 3 factories every year. Our labor intensity, we were 2,000 people 7 years back, we're 35,000 people now. So that support is also going to be helpful.
Well, Atul Lal, they're talking about the components PLI scheme, and I just wanted to make a point here, because in my conversation with the IT Minister, Ashwini Vaishnav in Davos, he did acknowledge the fact that the government is working on a PLI scheme for components. He also said that the consultation process was on, but did suggest that perhaps in the next few weeks we could hear something more about that. So whether we see an announcement in the budget or an outlay in the budget, I'm not sure. We'll have to wait to see. Of course, the expectation is that it'll be about 25,000 crores. That's the estimate at this point in time, but we'll have to wait to see. Mr. Lal, a quick comment from you on that?
Yeah, I appreciate it. We also have a similar understanding. So if there is some indication, some positive announcement, we know that the exact contours of the scheme is going to take some time to be rolled out, because it requires cabinet approvals and more complex processes. But some indication then is going to give a huge positive sentiment in the industry.
Yes, that certainly is the case. But I'd also like to welcome on the CNBC-TV18 budget headquarters our budget editors, Atanu Chakrabarti, the former Economic Affairs Secretary, now the Chairman of HDFC Bank, and Rathin Roy. Gentlemen, thank you very much for joining us. Well, not so bright and early, but bright and early for a Saturday morning for certain. Mr. Chakrabarti, let me start by asking you, overnight, any epiphanies on what possibly the Finance Minister could do or may do? Any out-of-the-box ideas at this point in time?
Well, all ideas are in the box, I guess.
they've been sealed. They've been sealed. Now they only have to be delivered. But, you know, Nilesh Shah was just talking about what could blow the market's mind. Possible gold monetization scheme, sovereign wealth fund, taxing those who are out of the tax net, perhaps taxing Indians who are leaving Indian shores, to go abroad. You think that any of that is something that the government may want to consider?
Well, government had on the gold front, gold monetization has been thought through, but frankly, even the sovereign gold bonds which had come out have been costing a lot. They are quite expensive for the government. Perhaps in some fashion if it could be used, but in any case the market is using it to create credit. So to some extent that's getting used without government getting into it.
And you're right, they pulled back even as far as the sovereign gold bonds are concerned because of how much it was costing the government.
Again, the idea of sovereign wealth funds have been there for quite some time, but it has to be linked to a very strong, powerful disinvestment program. It was talked about.
Any hope on that? Any hope on that? A very strong disinvestment program?
I have my prayers on that.
So you're not hoping?
I wish that disinvestment program picks up. Unfortunately, a lot of ideological things were attached to it. When it was happening, it was going great guns, almost 1 lakh crore per annum was happening. People said that companies are not getting privatized. So the ownership debate started and virtually killed the program. The narrative on which, frankly, which also happened perhaps from your studios, also to some extent killed it. I think people going out of India make for huge amount of remittances into the country. So taxing any of them, I don't think would not be a very sound economic idea. Because entry on exit of people, free market of let me use the word labor in that sense of term, as well as free market for capital. These are two essential prerequisites to maintain our growth rates.
Absolutely. Ratin Roy, literally about an hour and a half away from the budget now. Do you believe that in terms of priorities, things are likely to change, or, it will continue to be Capex, some sweeteners as far as consumption is concerned, and sticking to consolidation?
I certainly hope so, because I take a fairly realistic view of what government is capable of and what government is not capable of. And I'm very clear that the structural problems that the Indian economy faces are not going to be solved by tinkering with the budget. They require much more sort of whole of government action. So the best thing you can do in a budget is maintain macroeconomic stability, try and ensure that the budget does not respond to stuff like making markets go mad. Market going mad is the equivalent of a mujra. I don't want the market to get excited over mujra. I want the market to be excited over Indian economic fundamentals. So if the budget speaks to Indian economic fundamentals, and that involves stability, that would be a very good thing. And therefore, these kinds of everything that you mentioned that could happen in the budget will have an infra-marginal, irrelevant impact on the public finances. I think Otanu is right that the only place, we are not a net commodity exporter. Sovereign wealth funds are normally run by net commodity exporters. So if you did not want to spend disinvestment receipts in the year in which they were incurred, you might want to run a sovereign wealth fund for that. But that is irrelevant now, because the government is, in my view, not capable of disinvestment. And that is why you have this, the worst situation ever, I think, was in 2019, was it? When the government claimed they would do something like 2 lakh crores of disinvestment, end up with some pathetic number, 25,000, 30,000. That is the kind of nonsense that diminishes our credibility elsewhere. I must compliment the government. Since that date, if you either look at tax forecasts, whether you look at disinvestment forecasts, they've been very modest, very achievable, and the government more or less has delivered in, if you look at the RE, what it said it would in the BE. I'm hoping that track record continues and the government delivers in terms of, on the taxation side, in the RE what it said in the BE. On the expenditure side, I think the government is in a bind, which is important to understand. We're very interested to see how the finance ministry resolves this bind. If you reduce taxes, you reduce the space for public expenditure. You will therefore either have to cut expenditure as a percentage of GDP or increase borrowing. If you increase borrowing, you put further pressure on bond yields, which is not going to be a good signal for the markets. So that's I think, the real bind, that even small reductions in the tax GDP ratio, might well. Now people say corporate taxes have fallen. The only way, frankly, you can raise corporate taxes is by raising corporate tax rates.
Which I mean seems highly unlikely at this point.
Because profitability has fallen, you see.
Not just that, but also the signal that you send out. I mean, you're saying that you want to revive private investment and then to be able to even consider the possibility of hiking corporate tax rates.
I have a mild disagreement there, because I think private investment has not revived with low corporate tax rates.
No,
so if you want to make a trade-off and you want to increase private consumption demand of the rich, remember only the rich pay income tax in India, 3.5 times the per capita income, then you could raise corporate tax rates and lower personal income tax rates. But again, the impact would be infra-marginal. So I agree with you. I mean, it wouldn't be, I don't see any great urgency for the finance minister to do it. So I think this ought to be a steady as you grow budget. Normally with that sort of budget, you will see a lot of dramatic rhetoric. The Prime Minister already started his rhetoric yesterday. I expect to see a little more of that in the last budget. The last 3 budgets have been shorn of rhetoric because the Finance Ministry had a job to do. They had to deal with COVID, they had to reduce the fiscal deficit, and therefore the Finance Minister's speeches were mercifully short. I'm saying something to your listeners. The longer the speech, the less substantive will be the budget. So watch that speech.
Well, we will watch the speech. A quick final comment from you before I toss it back to Bombay. Mr. Chakrabarti, on the expenditure side now, this balancing act that they will need to do, something will have to be put on the table, something will have to be sacrificed. What is it likely to be?
Well, Rathin has very rightly said, your space on the face of it looks very limited. But it's very important to do the fiscal consolidation, otherwise to control the horses of inflation would become difficult, because fiscal policy and monetary policy are somewhere joined at the hip. Therefore, I guess the time has come to have another expenditure commission for somebody to sit down, go line item by line item. There's a lot of junk which remains. People miss it out. They go in as standing charges which need to be removed. and cut it out and make it much more leaner organization. Government has to become small,
So our
more
own
effective.
version of Dodge.
Well, not in that sense, but however, not something overnight, not something which is sort of shakes the market, but something which requires...
No, fair point.
It happened with the last, there were two expenditure commissions, which did a reasonably good job in setting, and that cuts at the margins, but very effective.
Well, that is certainly an idea that we don't know whether the government will take forward this time around or not, but our budget editors are going to be here with us through the day analyzing the fine print, and they have the experience of doing that, but for now it's back to the markets. Lata Prashant Surbi, over to you.
Thanks for that, Shireen, and the markets are holding up, keeping the green screen going, at least for now. Keeping the faith going, and the green screen is what we have, including a lot of buoyancy in mid-caps. We should keep pulling up some of these stocks, the budget-related stocks. PSUs is where the action is, your SJVN, a couple of these names, which is where the volumes are also on the higher side. NBCC, SJVN, these are up. And the infrastructure-related plays or the Capex-related plays, they've been doing well. And then there are names like Suzlon, of course, on the hopes of renewables getting a boost in the budget. Nilesh Shah is with us. So, Nilesh, some final thoughts. At the end of the day, it's all about portfolios and what to buy and what not. Now, I know in our earlier conversations, you've always been a big bull on technology, that too futuristic technology, some of these cutting-edge internet companies. So they're going through their own challenges. I mean, Zomato and them acknowledging the competitive intensity. So are you still as optimistic? And what else beyond them?
Well, the recent correction has made me even more optimistic.
Oh, okay.
Just look at where these stock prices were a month ago or 3 months ago. From there, they all have corrected probably between 20 to 40%. So be it essentially your quick commerce guys, your payment companies, travel aggregators, or some of the other platform companies providing services to mutual fund companies. This all has kind of corrected quite meaningfully, but the long-term prospects remain intact. Okay. So clearly, I believe that they've become even more compelling than where they were maybe a month ago, 3 months ago.
And
how
budget-related?
Gold. Budget-related. Because the expectation is that gold taxes, import duties were lowered because the government had to meet the sovereign bond outflow. But now they're expected to be raised because that's a major outflow for India in terms. You look at gold stocks at all?
Gold stock, the jewelry stocks, yes.
Exactly. That's what I meant.
Yeah. I think that's an interesting segment. And today we have a choice. 5 years ago, there was only one title. Today there's a choice, enough, and there's been a meaningful correction in many of them. I clearly believe it's a great place to be, especially if you're betting on an aspirational India, the shift from unorganized to organized, and the non-discretionary, the discretionary spend. So I think that looks fantastic. That space looks very attractive.
It's budget day. We can't let you go without asking industrials and Capex. Whatever is the view, and if you like, this space at all, then maybe, some idea of the kind of stocks you'll play.
Yeah, the cap goods, I think, is a fantastic place, especially companies which are leveraged to the potential in railways, in defense, electronics, overall. I think manufacturing, infra, and Capex cap goods, I think that's a fantastic place to be.
Good you brought up actually, electronics, because we just had that conversation with Dixon. What's your sense on this space? The thing is, when there is a good theme and a growth theme in the market, the whole market latches onto it. Then everybody has the same situation of 100p and 90p and how you deal with that. Some of it has started correcting, but again, how do you find them in terms of valuations?
No. I mean, optically, of course, the valuations still look high. But I think if there were to be a further correction of maybe 10-20% from there, I think it's a good place to be. I think growth will continue for the next 4 to 5 years. It's one of those very few pockets in the markets where essentially the investment opportunity aligns with the national priority. And therefore, I think it's a great place to be.
Okay. Keynes has fallen 33% from its highs, so perhaps attractive. Thank you very much, Nilesh, for all that advice.
Thank you.
But we have to take a quick break. Up next, we are going to connect with the tax experts. After all, we want to know whether we should expect lower personal income tax. Dinesh Kanabar will be with us, Mukesh Bhutani of BMR Legal, and Sunil Vadala of KPMG. Back in a minute.
Welcome back. The countdown is on and just about an hour to go before the Finance Minister presents the Union Budget in Parliament. And now we've discussed markets, we've discussed, of course, the global backdrop, we've discussed the big macro numbers. Let's boil it down to what really matters for you and me, which is taxation. That's what we're discussing with our next panel. And we have our experts joining in, Mr. Dinesh Kanabar of Dhruva Advisors, Mukesh Bhutani of BMR Legal, and we have with us Sunil Badala of KPMG. Gentlemen, thank you so much for joining in. I've been bothering most of you for the last several weeks, going back and forth on this rate and that and manufacturing companies and the new nature of the act, etc. But let's open with the big bold question. Do you expect the Finance Minister to really deliver a bonanza for the middle class? Mr. Kanabar, if I could start with you.
Just one question before we answer that is that we are told that in the same session, or maybe today itself, we are going to see a draft income tax code, a new law coming in. So what's going to be in that draft act and what's going to be in the budget is going to be an interesting play, because you cannot have all the changes coming in the finance bill or the budget and then say that there is going to be a bill which is also going to deliver something which is radically different or radically new. So it'll be interesting play to watch out there. But I do expect that in this
Mr. Kanabar, just for the sake of clarity on this, and I'm glad you raised this point, because what she announced in July was a review of the Act, the Income Tax Act of 1961. And then there was the Direct Tax Code, which was, formulated many years back, and then it kind of went into cold storage. So how does it play out? And from what I've gathered with conversations with all of you all is that the review of the Act is unlikely to touch the tax rates. That's going to be more on reducing litigation, simplified language, removing redundant provisions. But the code has to deal with the rates, right? So if we have to talk about an income tax cut, how does it all come together?
That's right. And the rates coming year on year. And I on your channel always wondered as to why do we need to tinker with the rates year and year. In fact, one simple proposition which I have always canvassed is that cannot the threshold limit beyond which you need to pay taxes be tied into an inflation index itself. But leaving that aside, given the fact that what the Finance Minister has been saying, what the Prime Minister has been saying about doing something for the lower and the middle class, I am indeed expecting both an increase in the threshold limit for taxation, and I'm expecting lower rates of tax going all the way, probably up to 15 lakhs of rupees. And I think that will be something very, very welcome. Again, I'm expecting all of these to be under the new regime and not the old regime, because that's what the government wants to do, to push people to the new regime, with which I totally agree.
All right, gentlemen, good morning. Thank you very much. Prashant, this side. There is suddenly this sharp focus which has been, which is shining on, which is this difference between what corporates pay as taxes and what individuals pay as taxes, right? It's become now, of course, with it's very stark. It's been stark for a while, but there is a lot of focus now on all of this. So, Mr. Bhutani, I just wanted, is there any way this can be? Will the government try to reduce this? I'm not sure if the corporate tax rate from 25 should go up, but on the individual side, can we see some changes to bring it lower?
I don't see why there should be alignment of corporate and individual tax rates. If you're going to tax businesses at higher rates of tax and not moderate rates of tax, you're making it anti-business. The whole philosophy behind taxing individuals at the higher maximum marginal rate of tax is to look at redistribution of income. That's the fundamental economic policy. Yes, at one point in time, the thinking was no matter what form of business you have, you should be taxed equally. But that is all in the passé. So I think that businesses should be taxed moderately. Individuals also should be taxed moderately, particularly in a country such as India. Otherwise, it gives opportunities for tax evasion or people having an outflight of capital or they themselves leaving the country. Okay. So I think the whole notion of having high corporate tax rates is, in my view, not the correct way to look at it. I think what needs to be looked into is what are the businesses that needs to be incentivized? And do you use tax rates for incentivization?
Yep.
For example, you had low rates on manufacturing that propelled manufacturing. Now that did not get extended, which came as a downer for many businesses. But if you ask me today, the corporate tax rates of 25% are still on the higher side. There is opportunity to look at India being more competitive and bring it down, if not to 20%, then at least to 22%.
Well, Mukesh, your point is taken, but that's not how you sell it to voters. And the middle class is today very vocal. You should see the number of memes. I'm sure you've got enough of them in terms of taxes. So, I mean...
you can sell that proposition to voters because voters are also comprising of small and medium enterprises. It's not just about a debate on what should be or what ought to be the corporate tax rate. You know, most of our businesses in India are run by partnerships and LLPs and private companies. I don't see any reason why this class of voters should be subjected to an unreasonable or a high rate of corporate tax.
Okay. As you speak, the Finance Minister now is entering Parliament building. So we are just counting down. It's less than an hour now for the budget. Sunil, your thoughts, I mean, in terms of encouragement for manufacturing, that 15%, of course, was a big ask and its extension, but we didn't get it last time. Anything in terms of encouraging FDI for that matter, for the gift city, through the gift city? What are the corporate sector's expectations?
So, so I think, first of all, let me just say that I agree with what Mr. Kanabar and Mr. Bhutani said. In terms of the expectations for the Aam Aadmi as well as for the manufacturing company, I think this is a big ask. Everybody is expecting that 15% concessional rate for the manufacturing should come in this budget. I also think that it's not just for the new manufacturing companies, but even for the existing companies, we should look at, let's say, some kind of an investment allowance or some incentive if they want to expand their existing manufacturing facilities, which we used to have decades ago, where, let's say, if I invested into the new facilities or I expanded the existing facilities, in addition to the depreciation, I would actually get some kind of an additional deduction of about 15%. Now, something similar can be looked at, in my view. Also, in order to encourage, let's say, R&D expenses or, startup, innovation, etc., some kind of a weightage, deduction should be considered. Now, coming back to the, FDI issues, etc., I think, looking at the volatility in the market, I think there is two expectations. Right. One is, the capital gains tax rates. And I know that there was a complete, change in the regime, but I think people are expecting, or people believe that the tax rates for both long-term and short-term are little on a higher side. So maybe we should have some reduction there. Also, the STT, looking at the buoyancy in the collection of the STT and the capital gains, maybe there is some expectation that some kind of a rate reduction in the STT should be considered.
Well, if they decide to roll back a bit on long-term and short-term capital gains, then we'll have a working Sunday as well. It'll be a huge headline. I don't know if that comes true or not. But, gentlemen, thank you for this sort of a quick take. We do have to take a break because the Finance Minister has now proceeded to enter Parliament. But we will come back to you as those announcements start trickling in. I think Shireen has the next set of guests with her as well. Shireen, over to you.
Going to be coming in just a second, Surabhi. Live from here, the CNBC-TV18 headquarters, we'll be joined by industry leaders from the Confederation of Indian Industry. And it's important there to pick up on the messaging that's being sent out by the tax advisors. Will they tinker with the capital gains rates? Remember, it was changed just last time around. So I don't know whether they are going to want to move so quickly or let the rates settle at this point in time. But of course, relief for the middle class, that's the big ask. And we'll take that conversation forward. We've also got with us our guests from FICCI joining us now. Let me go across to Anant Goenka and the FICCI president. Gentlemen, many thanks. The countdown has begun. The top three things that you believe the finance minister will deliver on, not wish list, what you believe they will finally deliver on. Anant, let me start by asking you.
What is the time now?
Anant, can you hear me? Well, we seem to be having... Harsh, can you hear me? Is my voice getting through to you?
Yeah, I can hear you now.
Yeah, very quickly to both you and Anant, the time for wish list is over. What do you think the finance minister will deliver on the top three things?
Sorry, can you repeat the question, Shireen? We couldn't hear properly.
Yeah, what will the finance minister deliver on Anant and Harsh? Anant, let me start by asking you.
Yeah, so I'd say the first three things that we're looking at. One is a budget of continuity, continued investment in capital investment. The second is focus on how do you do ease of doing business. And the third is putting some money in the hands of the consumer.
Capex and consumption. Harsh, what do you believe the finance minister is going to send out by way of messaging and signals to revive and unleash the animal spirits?
I think, from the government perspective, they will focus on the continuity. We have seen in the past, they have been quite consistent in their overall budget. And this time also we expect that the Capex expenditure, which has the multiplier effect, will continue, and we hope that the government increase their spend in that. As Anant was saying, consumption is a bit tepid. So how do we increase and help boost the consumption? So that is certainly, we hope to see some steps from the FM on that front. And also in the area of manufacturing, Make in India, in the area of PLI scheme, I think, we hope to see some activity there also.
Yes, more perhaps with regards to the PLI schemes. But Anant, let me come back to you. You did a survey of your FICCI members ahead of the budget. What's the mood, both in terms of hiring, in terms of capacity enhancement, in terms of current capacity utilization? I mean, how strong is sentiment today? Where does business confidence lie ahead of the budget?
Right, I'd say there are two parts to the survey. I'd say one is clearly there is more positivity on the rural side. On the urban side, there is some concern. However, I think as growth comes in, capacity utilizations go up, we are looking at an increase in private investment. I think the challenge on private investment has largely been on the consumption side. So if we can just add a little bit of sweetener out there, it'll make a big difference.
A little bit of a sweetener on the consumption side. Harsh, what is the expectation as far as tax relief is concerned? Realistically, what are you hoping for?
See, I believe, some kind of tax relief, especially at the lower end of the people, of the income group, that will certainly help boost the consumption and put in more money in the hand of the consumers, which will certainly help in the discretionary spend. So we are very hopeful, and to see some kind of steps there. And also at the corporate tax level, if they at the government level, at 15%, we expect to see something there as well.
Well, the return of that concessional scheme, which was phased out in 2024, we'll have to see whether that makes a comeback or not. Harsh and Anant, many, many thanks for joining us here on CNBC-TV18. We'll check back with you once the budget is delivered. But for now, the market's holding steady. Hero Moto under pressure today on account of the management changes, the CEO resigning there. The finance minister has arrived in Parliament ahead of the budget. It's 190 points higher on the Sensex, and the Nifty trending at 23,500 plus. So we will take a quick break and return with Voices from Industry. The Confederation of Indian Industry joins us right here on the CNBC-TV18 budget headquarters after this.
All right, thanks for that, Shireen. Let's dispense with the break and go straight away to our economists. We are joined by Sabiran Chakrabarti, the chief economist for City India, and Sajid Shenoy, head of Asia Economic Research at JP Morgan, also a member of the PMEAC, of course. Sajid, Samiran, thank you very much for being with us. Sajid, yesterday Anant Nageshwaran was very candid. He said you can't expect the government to cut fiscal deficit, add to capex and do welfare spending. So what do you think they'll do?
That's exactly right, Lata. I think when there's so much clamor about stimulus, it's important to understand the macro backdrop here, that fiscal deficits are coming down. And I think the government's been very good about fiscal marksmanship. So, when they say they want to have a deficit at 4.5% or below, I take them at their word. And I expect to see a 40 or 50 basis point of GDP consolidation. The question is, how will that be achieved? right? Will that be achieved on the revenue side, or will that be achieved by rationalizing expenditures? And my sense is that, with Capex, the good news is December Capex grew very strongly. So hopefully the undershoot in Capex that had been feared for this year will be less than expected. But the Capex story is an important one. I would expect for it to grow at least in line with nominal GDP. Right, so you want to ensure that Capex to GDP is at the same ratio.
So 10% over 11.1.
Well, the 11.1 may not be achieved because I think despite a strong December number, the asking rate for the next 3 months is still 55% growth year on year to get to the 11.1. So we may be, 10.5. But on that base, I think nominal GDP will grow at 10.5% like it has last year. So you'd expect to see Capex grow at least 10.5%. This then introduces interesting trade-offs because if Capex to GDP is not falling, where will you get the reduction in the fiscal deficit? Some of it happens because other expenditures, defense expenditures, interest expenditures, don't rise in line with nominal GDP. Subsidies should not rise in line with nominal GDP. So there'll be some savings there. But the broader point is it involves trade-offs here, that if you want a tax cut as the market is clamming for, then some revenue expenditure has to be cut and vice versa. I'll make one final point. It's important at a time where there's been some slowdown in growth that we get maximum bang for our buck from the fiscal. And fiscal multipliers tend to be higher on the expenditure side than on the tax side. So really what you want is not to compromise expenditures that are going at the bottom of the pyramid because those multipliers are higher. But these are the delicate trade-offs the budget will have to contend with.
Then you're clearly not the middle class's favorite, Sergeant. There is a lot of expectation.
I think a targeted tax cut is okay, but the space is limited.
I take your point. But Samiran, do you think Reserve Bank dividend can make a big difference? 2 lakh crore again is a reasonable expectation?
Yes, I mean, obviously, as we were discussing, Sajid was mentioning that there are no free lunches. So clearly, somewhere you have to get an additional source of revenue from. In the last year's budget, RBI dividend provided that source. This year also, the number could be very large, and it could make a difference between these marginal changes that are expected in different things. Like, say, for example, we are estimating that the income tax cut or the tweak could be somewhere slightly less than 0.1% of GDP. So that can get carved out of that additional RBI dividend. Because the other source that economists have been suggesting for a while now, which is increasing significantly the divestment revenue, that does not seem to be the path that the government is walking because of certain market conditions. So that way, the scope for increasing expenditure or tax cuts gets limited. Yes, RBI dividend will definitely be watched very, very closely.
Samiran, they did not walk that path on divestment when the market was in the most charitable mood also, right? But that's a debate for another time, another day, perhaps. I just want to go back to that Capex point and ask you, gentlemen, that, they started the year budgeting it at about, I think, 3.3% of GDP, right? Now with the slowdown, maybe they end up at 2.9% or 3% of GDP. Going forward, while, of course, Sajid has put forward the absolute expectations, the numbers for FY26 and, 10% in line with nominal GDP growth, as a percentage of GDP, would you expect Capex to continue to trend at those high levels of 3.3% or so, given what the economic survey is urging yesterday? Economic survey is saying, the government has done its heavy lifting. It's a bit of the heavy lifting. It's time for the private sector to move up. Now, will that at all show up in the numbers in any way? Samiran?
So my sense is that the Capex to GDP, public Capex, central government public Capex to GDP will not fall. But what is investors are increasingly looking at is exactly on what kind of things the government is spending. There is a perception that on the traditional sectors of roads, railways, defense, it's difficult to get that kind of high growth rates of 10 to 15% year over year, because there will obviously be some issues around whether the government will be execute them. So would there be some diversification of Capex into other sectors like urban development, housing, R&D, water? That's one sort of a discussion. The other is that if the government is not doing divestment and PSUs are becoming stronger, would we see the PSU Capex number to go up? If you recall, last few years, PSU Capex have been coming off. This PSU Capex has been going into the central government Capex. So if we see the PSU Capex number to go up, then the overall government Capex actually will look much better.
All right.
Okay. You know, I have an overarching expectation. I mean, all of us have. This economic policy framework, Samiran and Sajid, the promise was that she's going to announce something now which will kind of, cover for the medium term. What are you all expecting? Sajid first.
Today is going to be outside the budget math. There's so much focus on the budget math, but the short point is fiscal degrees of freedom are constrained when you're reducing deficits by 0.5% of GDP. In fact, Lata, what you said, I think, are the more important elements. The July speech spoke not just about an economic policy framework, it spoke about working with the states on, on structural reforms. It spoke about reimagining the financial architecture. It promised a review on basic customs duties to rationalize import tariffs. It spoke about, making the income tax code, much easier to navigate. I'll be looking at continuation on that. And I would, I think the economic policy framework is important because this is the first year of a third term. We've seen overnight tariffs in the US may well go up on Mexico and Canada and China today on February 1st. The global environment is much more hostile. The economic survey spoke about that. So the framework will be a really important document to lay out a path for, in this global environment, how can India get 7% growth? Where should the policy emphasis be? One last thing I'll say, remember, we're forgetting that employment was the overarching objective of the July budget. And it'll be good to get a scorecard on how those employment-linked incentives and internships are done. Will those programs be tweaked? And what will be the budget allocation? So I think there's a lot of very important signals that will come in the budget speech outside of the fiscal math, which is much more constrained.
No, absolutely. We didn't hear anything about those employment. They were going to take up the EPFO and ESI part of some people employed under 15,000 rupees, etc. Though it's not been operationalized. But Samiran, economic policy framework, what should we expect?
So if I take the economic survey's main message to be the driving principle behind the economic policy framework, then it's clearly going to focus on deregulation. There is a huge positive externality that can come out of it. We have all talked about it in the past, but probably never in such a strong and clear way, that how important this is in driving productivity, not only productivity in general, but in particular, it affects the small and medium enterprises the most, who are trying to build up their businesses. And that's where it is also important to understand that the whole employment debate that Sajid was referring to, that larger part of that employment happens in that space. Also, the fact that we often talk about India not being able to do as much labor-intensive exports and doing more of high-tech exports. Part of the reason could simply be that the cost of setting up business is so high that the lower margin businesses do not stay competitive. It is only the higher margin businesses which stay competitive. And that could be the reason why the economic policy framework would focus more on deregulation, ease of doing business, and that can cut across all factor markets, land, labor, etc.
All right. Gentlemen, thank you very much, both of you, Sajid and Samiran, for joining us with that perspective as we head into the budget. But not a long wait now. Another 40 minutes and we'll have the budget speech, at least beginning. Now, 50 points on the Nifty, so it's kind of holding on, waiting for that. And we'll have more on the other side. Up next, we will connect with our voices from India Inc. Sanjeev Puri, Rajiv Memani, R. Mukundan, Vinayak Chatterjee. So they'll all be joining Shireen from the CII Budget Headquarters.
8th consecutive time, Finance Minister Nirmala Sitharaman will rise to present the Union budget in a few hours from now. India's GDP growth is near a 2-year low. Can the budget unleash measures to fire up the growth engines?
It's important to understand that this drop happened just 2 quarters in the last 12 quarters that we're talking about. So let us not sort of pick on that one and predict future. This has been a steady growth and a steady sustained growth.
The new boss at Mint Street has unveiled measures to boost liquidity after the deficit hit a 15-year high. With monetary easing expected to begin this month, will the finance minister announce fiscal measures to bolster growth?
System liquidity is still tight and there is deficit.
The system needs more is liquidity. Liquidity is very low at this point, as you know, negative or 2.5 lakh or so.
Artificial intelligence has taken stock markets by storm.
How do we make AI all pervasive?
Powered by AI. AI first.
Artificial intelligence.
Ready for AI. AI is providing some cushion to that.
But as the corrections set in, investors are largely hoping for a status quo on taxes to stem the current downtrend. Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
Five, 4, 3, 2, 1.
Welcome back. You're watching our continuing coverage. We are counting down to the budget. 30 minutes to go for the Finance Minister Nirmala Sitharaman to rise to present her 8th budget. It is a record number of consecutive budgets delivered by a Finance Minister. We're here at the Confederation of Indian Industry. Joining me now, Sanjeev Puri, Vinayak Chatterjee and Rajiv Memani. Gentlemen, good morning. Many thanks for joining us. Sanjeev Puri, let me start by asking you, Capex consumption consolidation, what will the Finance Minister prioritize?
I think very clearly, like has been in the past, I think the focus will remain on inclusive and sustainable growth, and that growth through improving productivity of the economy, investments in the economy through public capex. And given the softness in consumption, we do believe there will be some relief provided to middle class by way of either income tax or reduction in duties on petroleum and so on and so forth. So we expect a combination of that, but the thrust of earlier budgets of increasing competitiveness of the economy, the productive capacity, I think that will certainly continue.
You know, on consumption, Sanjeev, and I based this on the question and the comment that came in from the Economic Affairs, the Chief Economic Advisor in his interview with me, when I asked him that how concerned is he about consumption, and he said that, look, we don't believe it's a structural problem. Rural economy has started to show signs of picking up, and we have seen a revival there. Urban is hurting at this point in time, but we don't believe that the consumption issues are a structural problem today. How do you look at the situation?
You see, ultimately, I think consumption is under pressure because of cost of certain items, particularly, the food inflation has been sticky, and that's so because of climate change. And because of that, I think the wallets are stretched. The other thing that stretched the wallets is the higher interest rates. There's a study published also which shows the share of EMI in a consumer's wallet has actually gone up. So there is stress, and that's why I think we are seeing consumption being a little soft. Once these factors are dealt with, and we do expect the interest rates also to moderate in February. Yeah, of course, that has to be preceded by liquidity injection, which has started to happen. Yeah. And both of this should provide relief, and I think some relief in the form of income tax or petroleum products. That will provide the
But
much
any
needed.
indication of volume growth picking up? And we certainly saw that with Nestle's numbers yesterday. Any indication of volume growth picking up?
Well, rural is doing picking up. Rural is picking up, but urban is still flattish. That's the general sense we have.
Urban flattish at this point in time. Vinayak Chatterjee, the bucket man, returns here on CNBC-TV18. How many buckets do you have for us? 7 buckets.
I prepared them because I knew you'd be pulling my leg, you know. So I said, Shireen's going to say that.
It is tradition. We can't let go of it.
Yeah. Anyway, I have 7, but I'll concentrate on the top 2. If there's time, I'll run through the balance 5. The real issue before the budget, Shireen, is the tension between controlling the glide path of fiscal deficit versus using infrastructure outlays to pump prime the economy. This is the ultimate tension in the budget. Now, the real question is, where is the Honorable Finance Minister putting her finger on this continuum? Now, last year was a disappointment because after many years of 30% growth in the infra outlay budgets, if you remember the past years, 5 lakh to 7.5, 7.5 to 10, they were all 30% increases. Last year, we got only 10% growth. 10 became 11.1. Now, this year, what is the range within which she can play? I mean, if it's going to be as conservative as last year, then we are not going to get infra to pump prime the economy and the slowdown and the Capex. And if you get only 10%...
But the government's point of view is that that's not conservative, that is still a pretty high Capex number, and it's now time for the private sector to also pick up the baton.
Well, private government expenditure in infra leads private Capex there. So the government, and remember, the government itself is touting the figure that 1 rupee spent on infrastructure results in 3 rupees of GDP, and 1 rupee spent on direct benefit transfer kind of expenditures results in 90 paisa of GDP. So the maths is very clear. If you want infra to pump prime the economy, particularly now when there already talk of slowdown in Capex, slowdown in GDP, then where are we going to see the FM put her finger? If she's going to be aggressive and go for a 25% increase in the infra outlay, then we are going to get 14 lakh crores as the budgetary outlay over 11.1 last year. And if she's going to be conservative, then we are going to get 12 lakh crores. So I'm keen to see where the government takes a stand. And the second point, and I'm going to stop very quickly after mentioning this, last time there was a hint in her budget speech. She said that the core infrastructure areas have reached a certain level of maturity and self-sustainability, which is largely transport and energy. And then she said other sectors of the economy now require attention. So I'm also keen to see in her budget announcements this time the interplay of the outlays between core and social infrastructure, and social meaning health, education, agriculture. I'm stopping here. The balance 5, if we have time.
I'll come to you very quickly for the balance 5 in just a second, but 12 to 14 lakh crores, that's the range that you're working with this time around as far as Capex is concerned. On the tax front, you know, if she needs to deliver on the range that Vinayak Chatterjee has just articulated, how much room does she have to do more than just provide sweeteners on the tax front?
Yeah, on the tax front, my view is that at least on the personal tax side, last 3 years, Shireen, the growth in personal tax revenues has been more than 20%. So at least on the personal tax side, and if you have to provide some fillip to consumption, and also from an equity standpoint, given the way lower income and middle income people have been hit because of inflation and other things, I think the government should provide relief at those levels. So I do believe that the government will be providing relief. What's the extent of relief? I think that we'll have to see. And you're right. I think that I think the fiscal glide path has to be maintained.
But do you think that they'll move on the rate and the slab, or do you think that will be more by way of exemptions?
No. I think they will go with the new tax scheme.
Yeah, absolutely. On the new tax scheme, bring in exemptions, or do you think that move as far as the rates slabs are concerned?
No, there are 3 levers. Either there is the tax rebate, so you can move that up. Standard deduction, then that impacts everything. Or you move the slab up, that the peak rate, which comes at 15 lakhs, that moves up slightly. So I don't know which they'll apply, but my sense is that the rebate amount that is there, they may increase that. because that gives relief at that level, and a little bit increase on the standard deduction side, because they won't want to tamper anything that changes with the number of people who are filing tax returns, because that's been one of the reasons that they want to track that number very closely.
On the corporate side, we saw changes as far as capital gains were concerned. The expectation is that given where the markets are, maybe they might provide a fillip by a cut. Do you expect that at all?
No. It may happen.
STT,
I don't expect
anything?
I don't expect. I think also if you see, Shireen, this government, they have not made too many, if I compare them with the earlier budgets, where you used to have lots of changes in tax. Now you have limited issues, so the direction is pretty clear in the way they want to go at it. So I don't anticipate too many changes. I do hope that they present the new tax draft income tax act to be opened up for discussion, and also be probably to put place in front of the standing committee, and then that will lead to real simplification. So a lot of the tax issues may be around simplification, and on corporate tax side.
That's the indication.
Yeah.
But on this business of the global context and responding to the global context under Trump administration, the threat of tariffs today is probably going to be the day where we see the first set of tariffs being imposed on Canada, Mexico, and perhaps even China. But Sanjeev Puri, from a manufacturing standpoint, from an FDI standpoint, what's the expectation, not just in terms of signaling, but also in terms of tangible steps? What do you expect?
So, this is a very difficult situation in the global context today. And therefore, we have to put in a lot more focus on the domestic drivers of competitiveness, which is what the Chief Economic Advisor also alluded to. So focus on competitiveness on sectors where we can really win and become a global hub. Second is, I think, this business of tariffs, or the complicated tariff walls that are emerging. This has been happening in the past, and we are seeing more of it happen. So really, we will have to really progress on FTAs. I think that's the way out, and use that route to integrate with global value chains. And the third is, I think, while it's not to do with tariffs, but there's also an issue of excess capacities in certain geographies that are dumping stocks all over, and therefore limiting opportunities. So we have to deal with that unfair competition. We need to have an agile response. So really in three parts. I think one is to focus on sectors where we have potential, where the world has potential, and some of it we spoke about also yesterday. Second is FTAs, and third is really to have agile responses to these issues of dumping. That's very, all these three are critical for manufacturing.
Anything specific on the Make in India agenda, bringing back the concessional scheme for new manufacturing units, perhaps some allowances even for corporates to expand existing units and so on and so forth? Anything there on Make in India 3.0?
So look, anything concessional is always welcome by industry.
But is that?
I'll really, if I was to really put it down, let me say that the balance sheets of corporates, the balance sheets of the financial system, they're in strong position, right? Corporate income tax rates were rationalized in the past. I think the big things to deal with right now are ease of doing business, cost of doing business, flexibility in labor regulations. A lot of it fall in this, in the ambit of the state. It's to provide specific targeted impetus to sectors that are labor intensive. See how we can pump prime agriculture even further. And this is the sector that the economic survey spoke about.
Absolutely.
To deal with the issue of resilience, because that feeds into inflation and then consumption.
It's interesting to see the mood here in industry is measured and tempered when it comes to things like, reductions or allowances or further incentives to India Inc. And that's because the survey made it clear corporate profitability has been at a 15-year high. But of course, the situation is looking a little bit more challenging now in terms of that, but a measured response. One final bucket before I let you go, and we'll toss it back to Bombay. Vinayak.
Final bucket would be a policy statement, long overdue, of a reduction of the 28% GST on an Aam Aadmi product called cement, which everybody considers irrational.
But it cannot be part of the budget. So
no, it can be part of a budgetary policy announcement. It's going to spur cost effectiveness in infrastructure. It will help Aam Aadmi, and it cannot be equated with pan masala, cement.
No. And there's a lot in that 28% bucket that needs to be addressed, but the budget perhaps is not going to veer into the GST territory at all. That will be for the GST GST Council. The gentlemen, we will check back in with you on how much of this is actually delivered by the Finance Minister. As always, many, many thanks for joining us here at the CNBC-TV18 Budget Headquarters. Guys, it's back to you.
All right, Shireen, thank you very much for that. That's an interesting discussion, and there is a lot going on in the markets as well. I mean, just sort of anticipating. And there are lots of moves, individual moves. How much will be validated, of course, is the question we'll have to wait and watch out for. That's a 0.25% higher for now, as far as the index is concerned. Keki Mistry is with us, former Vice Chair and CEO of HDFC. Mr. Mistry, it's always great to have you on an important day like the budget, as you've been with us in the past as well. So great to see you again. Just 20 minutes to go, and we'll have the budget speech starting. Visuals are already coming in. The Finance Minister in the Parliament. And those are live visuals which are coming in as we speak. We'll stay with the visuals. But Mr. Mistry, let me ask you, top of mind, 2 or 3 things in terms of, I mean, there are lots of asks, but in terms of real expectations, what would those be?
I would say growth, focus on growth. Second is focus on job creation. Third is leave money in the hands of people for consumption, to improve consumption in the economy. And the fourth, if you ask me, would be some reforms for the capital market.
Capital market reforms. Well, capital gains tax, I doubt they'll touch, will they, Mr. Mistry?
I don't know. I think some kind of, if we could have some kind of consistency in the tax rules, it would help a lot.
Can you be a little more specific? What could be your ask?
I'm saying if we were to say that the capital gains, the maximum, the capital gains, long-term capital gains now is going to be 12.5%, and that is the way it's going to be for the next X number of years, rather than keep, shuffling and making changes.
That's possible because she's also promised an economic policy framework announcement. So it's possible that something long-term will be announced there. But Mr. Mistry, let me come back to your old love, housing. I don't know when with the new tax regime, whether specific incentives can be announced for higher interest, higher principal set-offs and stuff like that. But overall, can housing expect something?
I think housing should expect something, because housing is a big employment generator.
Yes.
And we know that employment, creation of jobs is such an important facet of the budget. So there are certain policy decisions that could be taken. Like, for example, if there is a PME 2 scheme, we had a Prime Minister's Awas Yojana Scheme 1, which was extremely successful 5 or 6 years ago. Did very, very well. Now, if you were to have a PME 2, and that stretches to urban areas, then I think that would be a huge help to to the housing sector. Also, digitization of land records will help the rural economy. So there are many things like that can be done. Like, take, for example, rental market. In India, we look only at people staying in the house. But in the Western world, a lot of people buy property with the idea of leasing it out, renting it out. Now, if you rent it out, the interest that you pay on the loan is capped at 2 lakh rupees, which, is not going to make too much of sense. So that limit needs to be removed. There are things like that can be done, which could be done for the housing sector without increasing interest rates.
Got it. Just to tie in that point, you were about to say something on capital gains. Did you want to add something?
I wanted to talk about dividend. I mean, it's a long-drawn topic. We've talked about it multiple times. But if you really look at it, the dividend is getting taxed twice. The company is paying 25% tax on the dividend that it pays out because it's not getting a deduction on the dividend that they pay. And the individual is paying tax on dividend at the marginal tax rate. So if your tax rate, for example, is 30%, you're paying 30% tax plus 25% tax paid by the company. Now, plus, of course, the surcharge. So if we were to say that we tax dividend at the maximum marginal tax rate applicable to individuals, which currently is 30% plus surcharge, then the tax on dividend should really be curtailed to 5%. So then you're still taxing dividend at the maximum marginal tax rate.
Yeah.
Okay, Mr. Mistry, on capital gains, I think because it is at 12.5, right? The thing, I think that is the number. It's the 10, 15, or maybe it'll go to 15. You're not expecting a reduction, right? I mean, you're saying just clarity. Just
clarity that it will remain like this. I don't think I expect a reduction.
No, last year, there were a lot of people who were saying 12.5 looks like such an unstable number. Will they make it 15? You don't have such fears, do you?
I don't. I really don't, because I think we've seen a lot of middle income and below middle income people now investing in equity markets. And if you want to, already we've seen some pressure on equity markets in recent times. So in my opinion, I don't think there will be any change.
In terms of the CE, the economic the report yesterday, a survey also kind of alluded to it, right? Taxes have been cut in 2018-19 to from 35 to 25%, and the CE exhorting corporates to come in, participate, invest. Is there anything of that which kind of shows up in the budget in some way? I don't know how, but will that message be felt through the budget?
I think so. I think if we are to get growth into the system, but basically the idea is to create jobs. Now, how do you create jobs? You invest, you create more capacity, whether it is in infrastructure or in other industries. So some incentives for creating that extra capacity is something which I think is very, very much possible.
Okay. All right, Mr. Mistry, I hope they're listening. There's hardly any time, not much time for tweaks at least, but these, of course, especially the dividend point you're making, has been made, and let's see whether we have heard. We'll speak with you after the budget. Thank you very much indeed for joining us today. Okay, the market's in the green, so clearly there is some kind of an expectation. To be fair, of course, positions were also light. So let's get some final words from top stock market experts joining us now. Sandeep Bhatia, the Managing Director, Head of Equity India at Macquarie Capital. Dinesh Kanabar will be with us in a bit, the CEO of Dhruva Advisors. And we will also have Mahesh Nandurkar, Managing Director and Head of Research at Jefferies. Mahesh, Sandeep, Mr. Kanabar, thank you very much. Sandeep, what's the sense? I mean, have you bought or have you advised buying something before the budget in expectation of some sectors getting benefited?
So, the budgets are a lot of hype. Most of the times it's a big show when very little go. So it's not that we would say that buy this for the budget. I think as most of the panelists before me have echoed, the corporate sector has done structurally well in terms of profit and margins and cash flows. The banking sector is strong. The one part of the economy actually which is not done well is the household sector, and especially the middle income and poorer households. So I think if we see impetus to consumption, that itself will spur private capex, what we have not seen for some time, and we may not see if demand doesn't come back, is private capex. So I would be very happy if there's a spur to consumption. That's what I would expect from the budget. There is very little space otherwise to do something major. Given the fiscal glide path we are on, we need to control our fiscal deficit and gross borrowings. But definitely the surcharges which have been imposed and which need to go away, we can have some concessions there.
In what way? You said a boost to consumption you like. In what way, Sandeep?
Well, raise the minimum, the level at which tax starts coming in. So make it about, let's say, 1 lakh a month, 12 lakh, something like that. That would mean that if you're earning less than 1 lakh a month, you're not paying any taxes. So something like that. Plus, let's see if they can do anything on employment generation, incentivize corporates for employment generation. That is definitely needed. In my discussions with various senior economists of the government, they have noted the fact that the headcount growth has severely lagged behind the profit and earnings growth in the corporate sector over the last 7 to 10 years.
And the economic survey also mentions that the CA made that point yesterday as well, Sandeep. So in what way? Because further incentivization.
Yeah, I think there would be some way of saying that if you don't create a certain number of jobs over a period of time according to your top line growth or something, then your tax rates could go up. I think it has to be done very, very carefully because that can create more bureaucracy. But at least a push towards more formal employment will be necessary. I hope it is done without doing much damage. So I think some kind of a conversation also is important, and that has started.
Okay, actually, on that same point, let me get Mahesh Nandurkar in from Jefferies. Mahesh, do you think that we should and will get any stimulation for consumption?
So first of all, I would like to say that we are still in the fiscal consolidation mode. From the post-COVID era, we have already reduced our fiscal deficit by more than 400 basis points. But I think each year even from here on, and specifically in FY26, we would be looking at a 30-40 basis point reduction in the fiscal deficit. And given the fact that the revenue growth is unlikely to be more than 10% for the government of India, my belief is that the total expenditure growth is going to be, say, around 8% to 9% kind of mark. So that's the overall constraint within which I think we will have to view our expectations. So I think that the government has already done a lot of heavy lifting on the Capex side. In the last 5 years, the Capex has grown 3x. And it is quite natural to expect some kind of shift in that, away from Capex growth into consumption growth. But I think overall the limitation is going to be 8 to 9% total growth. So in that context, however, the government may like to give a big boost, but I think it will come with its own limitations.
Okay, all right. Mahesh is well put. Sunil Kaul is with us as well, Global Emerging Market Equity Strategist at Goldman Sachs, who's with us. Sunil, let me start by asking you, there is a lot of expectation that there could be further focus on public Capex. Your report, though, says growth pace for Capex is now behind us. What is your thinking and what are you expecting?
No, I think that's right, because, I mean, as we know, the government actually increased Capex spending at a rate of 30% CAGR between sort of calendar 21 to 2023, those 3 years, and took the fiscal spending as a percent of GDP from 1.5 to north of 3%, 3.2, 3.3%. So there has been a lot of fiscal spending that the government has done in prior years. And our strong view, even coming into last year, was that those growth rates are unlikely to sustain. And so the government will reduce the spending on fiscal more in line with nominal GDP, which is what they announced in the last budget as well. But I think this time also we'll think that the allocations to fiscal spending would be in line with sort of high, sort of low double digits of 10-11%, which is in line with the nominal GDP. So they will effectively keep the fiscal spending as a percent of GDP somewhat constant at around 3% of GDP.
Yeah, absolutely, Sunil. And that view really stands out because you're not expecting a decided uptick, continued uptick in the Capex spend. Mr. Kanabar, coming back to you now, we discussed the big expectation on income tax earlier, but I want to move beyond that as well. Aside of that, what are the other major things that you would watch out for? There's been so much of a clamor for simplification, for reducing litigation, the TDS regime, TCS and TCS rates. Would you expect anything else?
So even if I think the issue really is the cost of compliance, and the cost of compliance is just going up and up and up. And when we spoke earlier about TDS and TCS, the question is it really doing any benefit to have such a lot of litigation? And coming to litigation, I think the issue really is that today we have a backlog in the tax department, which is enormous. So just at a first appeal level, you have almost a 5 to 6 year waiting, which is unheard of and which has not been there for the last 15 years. The first time we are seeing such a lot of backlog, which essentially means that if there is an addition at the tax office level, the tax office collects 20%. The taxpayer believes he is out of pocket with that 20% unnecessarily. And should the taxpayer actually lose out, the government is out of pocket on 80%, and you can't have this situation continuing. A number of suggestions have been made in this regard, whether one can go directly to a tribunal, whether more cases can go to DRP. And I'll be waiting with bated breath to see what comes out of it. And those are very, very welcome things.
Okay. All right. On the rates per se, on the multiple TDS rates, just in 10 seconds, Mr. Kanabar, what are the changes you'd expect?
So the point really is that you have a tax rate for salaried employees, which is equal to their income so that they don't need to file a tax return. Then you have a higher TDS rate for lotteries and crypto and whatever else. And then all the other TDS, can it not be a one simple rate so that one is not really litigating with the tax office as to what is the applicable section? Should the withholding be at 2% or 5% or 10%?
Okay. Well, let's see what comes. Sandeep, well, finally, at the moment, what is attracting you in the market?
I think at the moment, one should look. So my assumption is that we'll see some tax cuts. So I think we can look at beneficiaries of tax cuts. I think to that extent, Maruti looks interesting in the near-term post-budget. If we do see a tax cut, small cars have been lagging. We all know that. At least sentimentally, these tax cuts can help. But there's also a pay revision commission, which has been announced by the government. Pay revisions will come through next year. So I think Maruti looks interesting at these levels. Other than that, it comes down to what happens in geopolitics. We have Trump and Modi meeting each other in February in the White House. I do expect some kind of a mini trade deal to come through. It's difficult to play this, but I think the Indian pharma sector is generally a beneficiary. So if we don't see any disruption, we definitely like Sun Pharma. So that's something. Otherwise, the private sector banks, I think the banking sector, it's a consensus call. I don't claim any special insight here. But some of the beaten down banks, such as Axis Bank or IndusInd Bank, could definitely look interesting because the system stability is definitely very strong.
Okay. All right, we are just about less than 10 minutes to the budget. Gentlemen, thank you very much for being with us. Shireen, last few thoughts from your guests?
Yeah, Lata, actually, we're 4 minutes away from the finance minister rising to present the budget speech. We've got our budget editors with us, Atanu Chakrabarti and Ratin Roy. By the way, there's a multilingual conversation happening here between the two of them. There's Bengali, there's Gujarati, there's Marathi. So I've been enjoying this multilingual budget banter that's taking place here with our budget editors. But Mr. Chakrabarti, to the point that was being made there, from a banking sector's perspective, from a financial services sector's perspective, what are you looking at the budget for?
Frankly, the major thing which really matters for the banking sector today is the savings, household savings, which have been eaten into by inflation. So most of the bankers would be looking at the fiscal deficit number and whether the debt containment happens, as I'd mentioned yesterday as well, this year, and maybe reduction possibly next year even. And the glide path, I wish, is even steeper, but at least glide path is followed. That will send the right signal for inflationary expectations. That will improve the savings. That doesn't eat into the wages. People would be willing to invest, increases wages across, improves savings. Improves even velocity of money. That's what bankers look at.
Well, speaking of the velocity of money, if we get that rate cut, first of all, do you believe we're getting a rate cut in February? If we do get that rate cut, do you expect that this encouraging signs of a pickup as far as private capex is concerned, that's likely to get a leg up?
Frankly, people would go by because there are different benchmarks that bankers use. And if inflation is low, most of them have pegged their rates either to 2-year bonds or 5-year bonds. So there the yields would come down and the rates would properly settle down. Whether rate cut itself would transmit into that or not would depend upon, frankly, the rate of inflation.
Yeah, on the global scenario, Ratan, and we were just discussing this, President Trump and Prime Minister Modi expected to meet. There is the possibility of some sort of a move ahead as far as a mini trade deal is concerned, etc. Do you believe that this budget is going to address, at least signal, anything on that front, on the global scenario? Is it likely to address even what's happening as far as the rupee depreciation with respect to the dollar is concerned?
I don't think so, because that's not the job of the budget. However, I think that I would expect the finance minister to at least comment on how India will navigate what promises to be a very turbulent year in terms of our bilateral and multilateral relationships, as the economic survey highlighted. So getting an endorsement of what the economic survey said, which is skillful, negotiated progress on the international front, would be important. And foreign investors will be looking more or less for the same kind of reassurance that Atanu was saying domestic investors will be looking at. You want a steady hand, you want a lower fiscal deficit, you don't really want to see any particular need to increase subsidies, and you want tax cuts to be moderated and not paid for by increased fiscal deficits, paid for ideally by lower public expenditure. So I think a steady budget would serve us best globally. India is fortunate amongst all the emerging economies at the moment to be one of the steadiest emerging economies. It is vital that we retain that because then the costs of the US imposing unilaterally tariffs or other constraints on us would be that much higher, since we're the only stable, steady, democratic emerging economy at present on this planet.
Yes,
I mean, just add a point here, since from the domestic perspective, but however, we also have another jurisdiction called gift jurisdiction.
Yes.
And now a lot of transactions, a lot of money has started moving into this. And but when the money moves in and out of the country, it tends to move directly back to Singapore or to Hong Kong. It needs to rest in gift. And gift possibly, maybe it's my wish, someday a separate chapter in our tax code gets written for that. So that there's a tax stability assurance in the mind. Today is through that ACZ rules and so on and so forth. That would set the ball rolling, because there are a lot of HNI investors, there are a lot of others, there are a lot of PE funds who are setting up their base there.
I'm sure that this is feedback that has been sent to the government. Have you heard anything on whether this is even an active consideration?
We can only hear today.
we'll only hear today.
But that's a wish, and I guess that those kind of feedback must have been gone, and I'm sure maybe a lot of things are work in progress always.
I would not be politically comfortable with this happening with GIFT. There's already too much talk about Gujarati oligarchies. And this would only add to that topic.
Well, gentlemen, I'm going to have to ask you to take a pause, because the Finance Minister rising in Parliament to present Budget 2025. This is going to be her 8th budget, 8th consecutive budget. On CNBC-TV18, we're calling it Seize the Moment. Will the budget capture the global context as well as unleash the animal spirits of the domestic industry? That's the big question. That is the action from Lok Sabha, the Speaker calling the House to order, and in just a moment from now you will see Finance Minister Nirmala Sitharaman rise to present the Union Budget.
बजट के बाद राज्यपाल अभिभाषण में आपको पर्याप्त दूंगा। मेरा आपसे निवेदन है, नहीं माननीय अखिलेश जी, आपने संसद की मर्यादा को आप बना के रखें। कभी बजट भाषण के अंदर इस तरीके का नहीं हुआ, ये उचित नहीं है, ये उचित नहीं है। अखिलेश जी प्लीज, मैं आपको मौका दूंगा राज्यपाल अभिभाषण पे, प्लीज। नो, ये तरीका ठीक नहीं है। नो, राज्यपाल अभिभाषण पे चर्चा होगी। नो तरीका।
Honorable Speaker, I present the budget for 25-26. This budget continues our government's efforts to A. Accelerate growth, B. Secure inclusive development, C. Invigorate private sector investments, D. Uplift household sentiments, and E. Enhance spending power of India's rising middle class. Together, we embark on a journey to unlock our nation's tremendous potential for greater prosperity and global positioning under the leadership of Honorable Prime Minister Shri Narendra Modi. As we complete the first quarter of the 21st century, continuing geopolitical headwinds suggest lower global economic growth over the medium term. However, our aspiration for a Vikasit Bharat inspires us, and the transformative work we have done during our government's first 2 terms guides us to march forward resolutely. Our economy is the fastest growing among all major economies. Our development track record for the past 10 years and structural reforms have drawn global attention. Confidence in India's capability and potential has only grown in this period. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth of all regions. The great Telugu poet and playwright Gurujada Apparao had said, Deshamante matti kadoy, Deshamante manushuloy, meaning a country is not just its soil, a country is its people. In line with this, for us, Vikasit Bharat encompasses zero poverty, 100% quality good school education, access to high quality, affordable and comprehensive health care, 100% skilled labor with meaningful employment, 70% women in economic activities, and farmers making our country the food basket of the world. In this budget, the proposed development measures span 10 broad areas, focusing on Garib, youth, Annadata, and Nari, spurring agricultural growth and productivity, building rural prosperity and resilience, taking everyone together on an inclusive growth path, boosting manufacturing and furthering Make in India, supporting MSMEs, enabling employment-led development, investing in people, economy, and innovation, securing energy supplies, promoting exports, and nurturing innovation. For this journey of development, our four powerful engines are agriculture, MSME, investments, and exports. The fuel, our reforms, our guiding spirit, inclusivity, and the destination, Vikasit Bharat. This budget aims to initiate transformative reforms across 6 domains. During the first 5 years, these will augment our growth potential and global competitiveness. The domains are taxation, power sector, urban development, mining, financial sector, and regulatory reforms. Agriculture as the first engine. Now I move to specific proposals, beginning with agriculture as the first engine. Prime Minister Dhan Dhanya Krishi Yojana, developing agri-districts program. Motivated by the success of the aspirational district program, our government will undertake a Prime Minister Dhan Dhanya Krishi Yojana in partnership with states. Through the convergence of existing schemes and specialized measures, the program will cover 100 districts with low productivity, moderate crop intensity, and below average credit parameters. It aims to 1. Enhance agricultural productivity, 2. Adopt crop diversification and sustainable agricultural practices, 3. Augment post-harvest storage at the panchayat and block level, 4. Improve irrigation facilities, and 5. Facilitate availability of long-term and short-term credit. This program is likely to help 1.7 crore farmers. Building rural prosperity and resilience. A comprehensive multi-sectoral rural prosperity and resilience program will be launched in partnership with the states. This will address underemployment in agriculture through skilling, investment, technology, and invigorating the rural economy. The goal is to generate ample opportunities in rural areas so that migration is an option but not a necessity. The program will focus on rural women, young farmers, rural youth, marginal and small farmers, and landless families. The details are in Annexure A. Domestic best practices will be incorporated, and appropriate technical and financial assistance will be sought from multilateral development banks. In phase 1, 100 developing agri-districts will be covered. Atmanirbharta in pulses. Our government is implementing the National Mission for Edible Oilseed for achieving Atmanirbharta in edible oils. our farmers have the capability to grow enough for our needs and more. 10 years ago, we made concerted efforts and succeeded in achieving near self-sufficiency in pulses. Farmers responded to the need by increasing the cultivated area by 50%, and government arranged for procurement and remunerative prices. Since then, with rising incomes and better affordability, our consumption of pulses has increased significantly. Our government will now launch a 6-year mission for Atmanirbharta in pulses with a special focus on Tur, Urad and Masoor. Details are in Annexure B. Central agencies such as NAFED and NCCF will be ready to procure these 3 pulses as much as offered during the next 4 years from farmers who register with these agencies and enter into agreements. Comprehensive program for vegetables and fruits. It is encouraging that our people are increasingly becoming aware of their nutritional needs. It is a sign of a society becoming healthier. With rising income levels, the consumption of vegetables, fruits, and Shri Anna is increasing significantly. A comprehensive program to promote production, efficient supplies, processing, and remunerative prices for farmers will be launched in partnership with the states. Appropriate institutional mechanisms for implementation and participation of farmer producer organizations and cooperatives will be set up. Makhana board in Bihar. For this, there is a special opportunity for the people of Bihar. A Makhana board will be established in the state to improve production, processing, value addition, and marketing of Makhana. The people engaged in these activities will be organized into FPOs. The board will provide hand-holding and training support to Makhana farmers and will also work to ensure they receive the benefits of all relevant government schemes. A national mission on high-yielding seeds will be launched, aimed at 1. Strengthening research ecosystem, 2. Targeted development and propagation of seeds with high yield, pest resistance, and climate resilience, and 3. Commercial availability of more than 100 seed varieties released since July 2024. India ranks 2nd largest globally in fish production and aquaculture. Seafood exports are valued at 60,000 crore rupees. To unlock the untapped potential of the marine sector, our government will bring in an enabling framework for sustainable harnessing of fisheries from Indian exclusive economic zone and high seas, with a special focus on the Andaman and Nicobar and Lakshadweep Islands. For the benefit of lakhs of cotton growing farmers, I am pleased to announce a mission for cotton productivity. This 5-year mission will facilitate significant improvements in productivity and sustainability of cotton farming and promote extra long staple cotton varieties. The best of science and technology support will be provided to farmers. Aligned with our integrated 5F vision for the textile sector, this will help in increasing incomes of the farmers and ensure a steady supply of quality cotton for rejuvenating India's traditional textile sector. Kisan credit cards facilitate short-term loans for 7.7 crore farmers, fishermen, and dairy farmers. The loan limit under modified interest subvention scheme will be enhanced from 3 lakh rupees to 5 lakh rupees for loans taken through the KCC. For Atmanirbharta in urea production, our government had reopened 3 dormant urea plants in the eastern region. To further augment urea supply, a plant with annual capacity of 12.7 lakh metric tons will be set up at Namrup in Assam. India Post, with 1.5 lakh rural post offices, complemented by the India Post Payment Bank and a vast network of 2.4 lakh Dak Sevaks, will be repositioned to act as a catalyst for the rural economy. Details are at Annexure C. India Post will also be transformed as a large public logistics organization. This will meet the rising needs of Vishwakarmas, new entrepreneurs, women, self-help groups, MSMEs, and the large business organizations. Our government will provide support to NCDC for its lending operations for the cooperative sector. MSMEs as the second engine. Now I move to MSMEs as the second engine, which encompasses manufacturing and services with a focus on MSMEs numbering 5.7 crores. Currently, over 1 crore registered MSMEs, employing 7.5 crore people and generating 36% of our manufacturing, have come together to position India as a global manufacturing hub. With their quality products, these MSMEs are responsible for 45% of our exports. To help them achieve higher efficiencies of scale, technological upgradation, and better access to capital, the investment and turnover limits for classification of all MSMEs will be enhanced to 2.5 and 2 times respectively. This will give them the confidence to grow and generate employment for our youth. The details are given in Annexure D. To improve access to credit, the credit guarantee cover will be enhanced. First, for micro and small enterprises from 5 crore to 10 crore rupees, leading to additional credit of 1.5 lakh crores in the next 5 years. Second, for startups from 10 crore rupees to 20 crore rupees, with the guarantee fee being moderated to 1% for loans in 27 focus sectors which are important for Atmanirbhar Bharat. And for well-run exporter MSMEs, for term loans up to 20 crore rupees. Also for the micro enterprises, we will introduce customized credit cards with a 5 lakh rupee limit for micro enterprises registered on Udyam portal. In the first year, 10 lakh such cards will be issued. Fund of funds for startups. The alternate investment fund, AIFs, for startups have received commitments of more than 91,000 crores rupees. These are supported by the fund of funds set up with the Government of India's contribution of 10,000 crore rupees. Now, a new fund of funds with expanded scope and a fresh contribution of another 10,000 crore rupees will be set up. A new scheme will be launched for 5 lakh women, scheduled castes and scheduled tribes, first-time entrepreneurs. This will provide term loans up to 2 crore rupees during the next 5 years. The scheme will incorporate lessons from the successful Stand Up India scheme. Online capacity building for entrepreneurship and managerial skills will also be organized. Measures for labor-intensive sectors. To promote employment and entrepreneurship opportunities in labor-intensive sectors, our government will undertake specific policy and facilitation measures. to enhance the productivity, quality and competitiveness of India's footwear and leather sector, a focused product scheme will be implemented. The scheme will support design capacity, component manufacturing, and machinery required for production of non-leather quality footwear, besides the support for leather footwear and products. The scheme is expected to facilitate employment for 22 lakh persons, generate over 4 lakh crore rupees, and exports of over 1.1 lakh crore rupees. Measures for the toys sector. Building on the National Action Plan for Toys, we will implement a scheme to make India a global hub for toys. The scheme will focus on development of clusters, skills, and a manufacturing ecosystem that will create high-quality, unique, innovative, and sustainable toys that will represent the Made in India brand. Support for food processing. In line with our commitment towards Purvodaya, we will establish a National Institute of Food Technology, Entrepreneurship and Management in Bihar. The institute will provide a strong fillip to food processing activities in the entire eastern region. This will result in 1. Enhanced income for the farmers through value addition to their produce, and 2. Skilling entrepreneurship and employment opportunities for the youth. Manufacturing mission, furthering Make in India. Our government will set up a national manufacturing mission covering small, medium and large industries for furthering Make in India by providing policy support, execution roadmaps, governance and monitoring framework for central ministries and states. Details are in Annexure E. Given our commitment to climate-friendly development, the mission will also support clean tech manufacturing. This will aim to improve domestic value addition and build our ecosystem for solar PV cells, EV batteries, motors and controllers, electrolyzers, wind turbines, very high voltage transmission equipment and grid scale batteries. Investment as the third engine. Now I move to investment as the third engine, which encompasses investing in people, investing in the economy, and investing in innovation. Investing in people. Saksham Anganwadi and Poshan 2.0. Saksham Anganwadi and Poshan 2.0 program provides nutritional support to more than 8 crore children, 1 crore pregnant women and lactating mothers all over the country, and about 20 lakh adolescent girls in aspirational districts and the Northeast region. The cost norms for these nutritional support will be enhanced appropriately. Atal Tinkering Labs. 50,000 Atal Tinkering Labs will be set up in government schools in the next 5 years to cultivate the spirit of curiosity and innovation and foster a scientific temper among young minds. Broadband connectivity to government secondary schools and PHCs. Broadband connectivity will be provided to all government secondary schools and primary health centers in rural areas under the BharatNet project. Bharatiya Bhasha Pustak Scheme. We propose to implement a Bharatiya Bhasha Pustak scheme to provide digital form Indian language books for schools and for higher education. This aims to help students understand their subjects better and in their language. National Centers of Excellence for Skilling. Building on the initiative announced in the July 24 budget, 5 National Centers of Excellence for Skilling will be set up with global expertise and partnerships to equip our youth with the skills required for Make for India, Make for the World manufacturing. The partnership will cover curriculum design, training of trainers, and a skills certification framework and periodic reviews. Expansion of capacity in IITs. Total number of students in 23 IITs has increased 100% from 65,000 to 1.35 lakh in the past 10 years. Additional infrastructure will be created in the 5 IITs started after 2014 to facilitate education for 6,500 more students. Hostel and other infrastructure capacity at IIT Patna will also be expanded. Center of Excellence. Center of Excellence in AI for Education. I had announced 3 centers of excellence in artificial intelligence for agriculture, health, and sustainable cities in 2023. Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores. Expansion of medical education. Our government has added almost 1.1 lakh undergraduate and postgraduate medical education seats in 10 years, an increase of 130%. In the next year, 10,000 additional seats will be added in medical colleges and hospitals towards the goal of adding 75,000 seats in the next 5 years. Daycare cancer centers in all district hospitals. Our government will facilitate setting up of daycare cancer centers in all district hospitals in the next 3 years. 200 centers will be established in 25-26 itself. Strengthening urban livelihoods. Our government has been giving priority to assisting urban poor and vulnerable groups. A scheme for socio-economic upliftment of urban workers will be implemented to help them improve their incomes, have sustainable livelihoods, and a better quality of life. PM Swanidhi scheme has benefited more than 68 lakh street vendors, giving them respite from high-interest informal sector loans. Building on this success, the scheme will be revamped with enhanced loans from banks, UPI-linked credit cards with 30,000 rupees limit, and capacity building support. Social Security scheme for welfare of online platform workers. Gig workers of online platforms provide great dynamism to the new age services economy. Recognizing their contribution, our government will arrange for their identity cards and registration on the e-Shram portal. They will be provided healthcare under PM Jan Arogya Yojana. This measure is likely to assist nearly 1 crore gig workers. Investing in the economy. Public-private partnership in infrastructure. Each infrastructure-related ministry will come up with a 3-year pipeline of projects that can be implemented in PPP mode. States will also be encouraged to do so and can seek support from the India Infrastructure Project Development Fund, which is a scheme to prepare PPP proposals. Support to states for infrastructure. An outlay of 1.5 lakh crore is proposed for the 50-year interest-free loans to states for capital expenditure and incentives for reforms. Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects. Regulatory and fiscal measures will be fine-tuned to support the plan. Jal Jeevan Mission. Since 2019, 15 crore households representing 80% of India's rural population have been provided access to portable tap water connections. To achieve 100% coverage, I am pleased to announce the extension of this mission until 2028 with an enhanced total outlay. The mission's focus will be on the quality of infrastructure and O&M of rural piped water supply schemes through Jan Bhagidari. A separate MOU or separate MOUs will be signed with the states and union territories to ensure sustainability and citizen-centric water services delivery. Urban sector reforms. Building on the July budget proposals, urban sector reforms related to governance, municipal services, urban land and planning will be incentivized. Urban Challenge Fund. The government will set up an urban challenge fund of 1 lakh crore rupees to implement the proposals for cities as growth hubs, creative redevelopment of cities, and for water and sanitation purposes announced in the July budget. This fund will finance up to 25% of the cost of bankable projects, with a stipulation that at least 50% of the cost is funded from bonds, bank loans, and PPPs. An allocation of 10,000 crore is proposed in 2025-26. Power sector reforms. We will incentivize electricity distribution reforms and augmentation of intra-state transmission capacity by states. This will improve financial health and capacity of electricity companies. Additional borrowing of 0.5% of GSDP will be allowed to states contingent on these reforms. Nuclear energy mission for Vikasit Bharat. Development of at least 100 gigawatt of nuclear energy by 2047 is essential for our energy transition efforts. For an active partnership with the private sector towards this goal, amendments to the Atomic Energy Act and the Civil Liability for Nuclear Damage Act will be taken up. A nuclear energy mission for research and development of small modular reactors with an outlay of 20,000 crore will be set up. At least 5 indigenously developed small modular reactors will be operationalized by 2033. Shipbuilding. The shipbuilding financial assistance policy will be revamped to address cost disadvantages. This will also include credit notes for shipbreaking in Indian yards to promote the circular economy. Large ships above a specified size will be included in the infrastructure harmonized master list. Shipbuilding clusters will be facilitated to increase the range, categories, and capacity of ships. This will include additional infrastructure, facilities, skilling, and technology to develop the entire ecosystem. Maritime Development Fund. For long-term financing for the maritime industry, a Maritime Development Fund with a corpus of 25,000 crore rupees will be set up. This will be for distributed support and promoting competition. This will have up to 49% contribution by the government, and the balance will be mobilized from ports and from private sector. Udan regional connectivity schemes. Udan has enabled 1.5 crore middle-class people to meet their aspirations for speedier travel. The scheme has connected 88 airports, and operationalized 619 routes. Inspired by that success, a modified Udan scheme will be launched to enhance regional connectivity to 120 new destinations and carry 4 crore passengers in the next 10 years. 4 crore additional passengers in the next 10 years. The scheme will also support helipads and smaller airports in hilly, aspirational and northeast regional districts. Greenfield airports will be facilitated in Bihar to meet the future needs of the state. These will be in addition to the expansion of the capacity of Patna Airport and a brownfield airport in Beta. Western Kosi Canal project in Mithilanchal. Financial support will be provided for the Western Kosi Canal ERM project, benefiting a large number of farmers, cultivating over 50,000 hectares of land in the Mithilanchal region of Bihar. Mining sector reforms. Mining sector reforms, including those for minor minerals, will be encouraged through sharing of best practices and institutions of a state mining index. A policy for recovery of critical minerals from tailings will be brought out. Under the special window for affordable and mid-income housing, SWAMI, 50,000 dwelling units in stressed housing projects have been completed and keys handed over to home buyers. Another 40,000 units will be completed in 2025, further helping middle-class families who are paying EMIs on loans taken for apartments while also paying rent for their current dwellings. Building on this success, established as a blended finance facility with contribution from the government, banks and private investors. This fund of 15,000 crore rupees will aim for expeditious completion of another 1 lakh units. PM Gati Shakti data for private sector. For furthering PPPs and assisting the private sector in project planning, access to relevant data and maps from the PM Gati Shakti portal will be provided. Tourism for employment-led growth. Top 50 tourist destination sites in the country will be developed in partnership with states through a challenge mode. Land for building key infrastructure will have to be provided by the states. Hotels in these destinations will be included in the infrastructure harmonized list. The following measures will be taken for facilitating employment-led growth. Organizing intensive skill development programs for our youth, including in institutes of hospitality management. Providing mudra loans for homestays. Improving ease of travel and connectivity to tourist destinations. Providing performance-linked incentives to states for effective destination management, including tourist amenities, cleanliness, and marketing efforts. And introducing streamlined e-visa facilities along with visa fee waivers for certain tourist groups. Continuing with the emphasis on places of spiritual and religious significance in the July budget, there will be a special focus on destinations related to the life and times of Lord Buddha, Medical tourism and heal in India. Medical tourism and heal in India will be promoted in partnership with the private sector, along with capacity building and easier visa norms. Investing in innovation. To implement private sector-driven research, development and innovation initiatives announced in the July budget, I am now allocating 20,000 crore rupees for this purpose. A deep tech fund of funds will also be explored to catalyze the next generation startups as a part of this initiative. In the next 5 years, under the PM Research Fellowship Scheme, we will provide 10,000 fellowships for technological research in IITs and IISc with enhanced financial support. The second gene bank with 10 lakh germplasm lines will be set up for future food and nutritional security. This will provide conservation support to both public and private sectors for genetic resources. We will start a national geospatial mission to develop foundational geospatial infrastructure and data. Using PM Gati Shakti, this mission will facilitate modernization of land records, urban planning, and design of infrastructure projects. A Gyan Bharatam mission for survey, documentation, and conservation of our manuscript heritage with academic institutions, museums, libraries, and private collectors will be undertaken to cover more than 1 crore manuscripts. We will set up a national digital repository of Indian knowledge systems for knowledge sharing. Now I move to exports as the fourth engine. We will set up an export promotion mission with sectoral and ministerial targets driven jointly by the Ministries of Commerce, MSME, and Finance. It will facilitate easy access to export credit, cross-border factoring support, support to MSMEs to tackle non-tariff measures in overseas markets. A digital public infrastructure, Bharat Trade Net, for international trade will be set up as a unified platform for trade documentation and financing solutions. This will complement the Unified Logistics Interface platform. The BTN will be aligned with international practices. Support will be provided to develop domestic manufacturing capacities for our economy's integration with global supply chains. Sectors will be identified based on objective criteria. Facilitation groups with participation of senior officers and industry representatives will be formed for select products and supply chains. Through this, there are huge opportunities related to Industry 4.0, which needs high skills and talent. Our youth have both. Our government will support the domestic electronic equipment industry to leverage this opportunity for the benefit of our youth. A national framework will be formulated as guidance to states for promoting global capability centers in emerging Tier 2 cities. This will suggest measures for enhancing availability of talent and infrastructure, building bylaw reforms, and mechanisms for collaboration with industry. Our government will facilitate upgradation of infrastructure and warehousing for air cargo, including high-value perishable horticultural produce. Cargo screening and customs protocol will be streamlined and made user-friendly. Reforms as the fuel. Over the past 10 years, our government has implemented several reforms for convenience of taxpayers, such as faceless assessment, 2. Taxpayer charter. 3. Faster returns. 4. Almost 99% returns being on self-assessment. And 5. Vivad Se Vishwas scheme. Continuing these efforts, I reaffirm the commitment of the Tax Department to trust first, scrutinize later. I also propose to introduce the new income tax bill next week. I will detail the indirect tax reforms and changes in direct taxes in Part B. Financial sector reforms. The FDI limit for the insurance sector will be raised from 74 to 100%. This enhanced limit will be available for those companies which invest the entire premium in India. The current guardrails and conditionalities associated with foreign investment will be reviewed and simplified. The services of India post-payment bank will be deepened and expanded in rural areas. NABFID will set up a partial credit enhancement facility for corporate bonds for infrastructure. Public sector banks will develop Grameen Credit Score framework to serve the credit needs of SHG members and people in rural areas. A forum for regulatory coordination and development of pension products will be set up. To implement the earlier announcement on simplifying the KYC processes, the revamped Central KYC Registry will be rolled out in 2025. We will also implement a streamlined system for periodic updating. Requirements and procedures for speedy approval of company mergers will be rationalized. The scope for fast-track mergers will also be widened and the process made simpler. As proposed in the interim budget, we signed bilateral investment treaties with 2 countries in 2024 to encourage sustained foreign investment, and in the spirit of First Develop India, the current model BIT will be revamped and made more investor-friendly. In the last 10 years, in several aspects, including financial and non-financial, our government has demonstrated a steadfast commitment to ease of doing business. We are determined to ensure that our regulations must keep up with technological innovations and global policy developments. A light touch regulatory framework based on principles and trust will unleash productivity and employment. Through this framework, we will update regulations that were made under old laws. To develop this modern, flexible, people-friendly, and trust-based regulatory framework appropriate for the 21st century, I propose 4 specific measures. A high-level committee for regulatory reforms will be set up for a review of all non-financial sector regulations, certifications, licenses, and permissions. The committee will be expected to make recommendations within a year. The objective is to strengthen trust-based economic governance and take transformational measures to enhance ease of doing business, especially in matters of inspection and compliances. States will be encouraged to join in this endeavor. An investment friendliness index of states will be launched in 2025 to further the spirit of competitive, cooperative federalism. Under the Financial Stability and Development Council, a mechanism will be set up to evaluate impact of the current financial regulations and subsidiary instructions. It will also formulate a framework to enhance their responsiveness and development of the financial sector. In the Jan Vishwas Act 2023, more than 180 legal provisions were decriminalized. our government will now bring up the Jan Vishwas Bill 2.0 to decriminalize more than 100 provisions in various laws. I now move to fiscal policy. In the July budget, I had committed to staying the course for fiscal consolidation. Our endeavor will be to keep the fiscal deficit each year such that central government debt remains on a declining path as a percentage of the GDP. The roadmap for the next 6 years has been detailed in the FRBM statement. Revised estimates for 2024-25. The revised estimate of the total receipts other than borrowings is 31.47 lakh crore rupees, of which the net tax receipts are 25.57 lakh crore rupees. The revised estimate of the total expenditure is 47.16 lakh crore rupees, of which the capital expenditure is about 10.18 lakh crore rupees. The revised estimate of the fiscal deficit is 4.8% of the GDP. Budget estimates for 25-26. Coming to 25-26, the total receipts other than borrowings and total expenditure are estimated at 34.96 lakh crore rupees and 50.65 lakh crore rupees respectively. The net tax receipts are estimated at 28.37 lakh crore rupees. The fiscal deficit is estimated to be 4.4% of GDP. To finance the fiscal deficit, the net market borrowings from dated securities are estimated at 11.54 lakh crore. The balance financing is expected to come from small savings and other sources. The gross market borrowings are estimated at 14.82 lakh crore rupees. I will now move to Part B. Indirect taxes. My proposals relating to customs aim to rationalize tariff structure and address duty inversion. These will also support domestic manufacturing and value addition, promote exports, facilitate trade, and provide relief to common people. Rationalization of customs tariff structure for industrial goods. As a part of comprehensive review of customs rate structure announced in July 2024 budget, I propose to 1. Remove 7 tariff rates. This is over and above the 7 tariff rates removed in 23-24 budget. After this, there will be only 8 remaining tariff rates, including 0 rate. 2. Apply appropriate cess to broadly maintain effective duty incidence, except on a few items where such incidence will reduce marginally. 3. Levy not more than 1 cess or surcharge. Therefore, I propose to exempt social welfare surcharge on 82 tariff lines that are subject to a cess. I shall now take up sector-specific proposals. To provide relief to patients, particularly those suffering from cancer, rare diseases, and other severe chronic diseases, I propose to add 36 life-saving drugs and medicines to the list of medicines fully exempted from basic custom duty. I also propose to add 6 life-saving medicines to the list attracting concessional custom duty of 5%. Full exemption and concessional duty will also respectively apply on the bulk drugs for manufacture of the above. Specified drugs and medicines under patient assistance programs run by the pharmaceutical companies are fully exempt from BCD, provided the medicines are supplied free of cost to the patients. I propose to add 37 more medicines along with 13 new patient assistance programs, support to domestic manufacturing and value addition, critical minerals. In the July 2024 budget, I had fully exempted BCD on 25 critical minerals that are not domestically available. I had also reduced BCD of 2 other such minerals to provide a major fillip to their processing, especially by MSMEs. Now, I propose to fully exempt cobalt powder and waste, the scrap of lithium-ion battery, lead, zinc, and 12 more critical minerals. This will help secure the availability for manufacturing in India and promote more jobs for our youth. To promote domestic production of technical textile products such as agro-textiles, medical textiles, and geotextiles at competitive prices, I propose to add 2 more types of shuttle-less looms to the list of fully exempted textile machinery. I also propose to revise the BCD rate on knitted fabrics covered by 9 tariff lines from 10 or 20 to 20% or 115 rupees per kg, whichever is higher. Electronic goods. In line with our Make in India policy and to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20% and reduce the BCD to 5% on open cell and other components. In 23-24 budget, for the manufacture of open cells of LCD, LED TVs, I had reduced the BCD on parts of open cells from 5% to 2.5%. To further boost the manufacture of such open cells, the BCD on these parts will now stand exempted. Lithium-ion battery. To the list of exempted capital goods, I propose to add 35 additional capital goods for EV battery manufacturing and 28 additional capital goods for mobile phone battery manufacturing. This will boost domestic manufacture of lithium-ion batteries, both for mobile phones and for electric vehicles. Shipping sector. Considering that shipbuilding has a long gestation period, I propose to continue the exemption of BCD on raw materials, components, consumables, or parts for the manufacture of ships for another 10 years. I also propose the same dispensation for shipbreaking to make it more competitive. Telecommunication. To prevent classification disputes, I propose to reduce the BCD from 20% to 10% on carrier-grade Ethernet switches to make it at par with non-carrier-grade Ethernet switches. Export promotion. To facilitate exports of handicrafts, I propose to extend the time period for export from 6 months to 1 year, further extendable by another 3 months if required. I also propose to add 9 items to the list of duty-free inputs. Leather sector. I propose to fully exempt BCD on wet blue leather to facilitate imports for domestic value addition and employment. I also propose to exempt crust leather from 20% export duty to facilitate exports by small tanners. Marine products. To enhance India's competitiveness in the global seafood market, I propose to reduce BCD from 30% to 5% on frozen fish paste, surimi, for manufacture and export of its analog products. I also propose to reduce BCD from 15% to 5% on fish hydrolysates for manufacture of fish and shrimp feed. In July 2024 budget, to promote development of domestic MROs for aircraft and ships, I had extended the time limit for export of foreign origin goods that were imported for repairs from 6 months to 1 year and further extendable by 1 year. I now propose to extend the same dispensation for railway goods. Time limit for provisional assessment. Presently, the Customs Act 1962 does not provide any time limit to finalize provisional assessments, leading to uncertainty and cost to trade. As a measure of promoting ease of doing business, I propose to fix a time limit of 2 years, extendable by a year, for finalizing the provisional assessment. I propose to introduce a new provision that will enable importers or exporters, after clearance of goods, to voluntarily declare material facts and pay duty with interest but without penalty. This will incentivize voluntary compliance. However, this will not apply in cases where department has already initiated audit or investigation proceedings. For industry to better plan their imports, I propose to extend the time limit for the end use of imported inputs in the relevant rules from 6 months to 1 year. This will provide operational flexibility in view of cost and uncertainty of supply. Further, such importers will now have to file only quarterly statements instead of a monthly statement. I now come to my direct tax proposals. In Part A, I have briefly underlined taxation reforms as one of key reforms to realize our vision of Vikasit Bharat. In respect of criminal law, our government had earlier ushered in Bharatiya Nyaya Sanhita, replacing Bharatiya Danda Sanhita. I am happy to inform this august House and the country that for new income tax bill will carry forward the same spirit of Nyaya in its drafting as well. The new bill will be clear and direct in text, with close to half of the present law in terms of both chapters and words. It will be simple to understand for taxpayers and tax administrators, leading to tax certainty and reduced litigation. Reforms, however, are not a destination. They are means to achieve good governance for our people and economy. Providing good governance primarily involves being responsive. The Tirukural captures this in verse 542, which reads, "Vaanokki vaazhum ulagallam, mannavan kol nokki vaazhum kudi," meaning, just as the living beings live expecting rains, citizens live expecting good governance. Our government is committed to keeping an ear to the ground and a finger on the pulse and responding while balancing our national building efforts. The following measures will detail just how our government will, under the guidance of PM Modi, has taken steps to understand and address. I repeat that sentence, sir. The following measures will detail just how our government, under the guidance of PM Modi, has taken steps to understand and address the needs voiced by our citizens. My tax proposals are guided by this spirit. The objectives of my proposals are as follows. Personal income tax reforms with special focus on middle class. Rationalization of TDS and TCS for easing difficulties. Encouraging voluntary compliance. Reducing compliance burden. Ease of doing business. Employment and investment. I will come to my proposal on personal income tax towards the end. TDS and TCS, rationalization for easing difficulties. I propose to rationalize tax deduction at source, TDS, by reducing the number of rates and thresholds above which TDS is deducted. Further, threshold amounts for tax deduction will be increased for better clarity and uniformity. The limit for tax deduction on interest for senior citizens is being doubled from the present 50,000 rupees to 1 lakh rupees. Similarly, the annual limit of 2.40 lakh rupees for TDS on rent is being increased to 6 lakh rupees. This will reduce the number of transactions liable to TDS, thus benefiting small taxpayers receiving small payments. The threshold to collect tax at source, the TCS, on remittances under RBI's liberalized remittance scheme, the LRS, is proposed to be increased from 7 lakh to 10 lakhs. I also propose to remove TCS on remittances for education purposes, where such remittances is out of a loan taken from a specified financial institution. Both TDS and TCS are being applied on any transaction related to sale of goods. To prevent such compliance difficulties, I propose to omit the TCS. I also propose that the provisions of the higher TDS deduction will now apply only in non-PAN cases. In July 2024, the delay for payment of TDS up to the due date of filing statement was decriminalized. I propose to provide the same relaxation to TCS provisions as well. The government under the leadership of Prime Minister Modi believes in Sabka Saath, Sabka Vikas, Sabka Vishwas and Sabka Prayas. In line with this, we brought in updated return facility in 2022 for voluntary compliance by taxpayers who had omitted to report their correct income. Our trust in taxpayers was proved right. Nearly 90 lakh taxpayers voluntarily updated their incomes by paying additional tax. Taking this trust further, I now propose to extend the time limit to file updated returns for any assessment year from the current limit of 2 years to 4 years. I propose to reduce the compliance burden for small charitable trusts and institutions by increasing their period of registration from 5 years to 10 years. It is also proposed that disproportionate consequences do not arise for minor defaults such as incomplete applications filed by charitable entities. Presently, taxpayers can claim the annual value of self-occupied properties as nil only on the fulfillment of certain conditions. Considering the difficulties faced by taxpayers, it is proposed to allow the benefit of 2 such self-occupied properties without any condition. To streamline the process of transfer pricing and to provide an alternative to yearly examination, I propose to introduce a scheme for determining arm's length price of international transaction for a block period of 3 years. This will be in line with global best practices. With a view to reduce litigation and provide certainty in international taxation, the scope of safe harbor rules is being expanded. A number of senior and very senior citizens have very old national savings schemes accounts. As interest is no longer payable on such accounts, I propose to exempt withdrawals made from NSS by individuals on or after 29th August 2024. I am also proposing to allow similar treatment to NPS Vatsalya accounts as is available to normal NPS accounts subject to overall limits. In my speech in July 2024, I had promised that all processes, including giving effect to appellate orders, shall be digitalized and made paperless over the next 2 years. So I'm happy to announce that digitalization is being made operational now. In July 2024, we brought in the Vivad Se Vishwas scheme to resolve income tax disputes pending in appeal. The scheme has received a great response, with nearly 33,000 taxpayers having availed of the scheme to settle their disputes. I have a few proposals to promote investment and employment. It is proposed to provide a presumptive taxation regime for non-residents who provide services to a resident company that is establishing or operating an electronics manufacturing facility. I further propose to introduce a safe harbor for tax certainty for non-residents who store components for supply to specified electronics manufacturing units. Presently, the tonnage tax scheme is available only to sea-going ships. The benefits of existing tonnage tax scheme are proposed to be extended to inland vessels registered under the Indian Vessels Act 2021 to promote inland water transport in the country. Extension for incorporation of startups. We continue to support the Indian startup ecosystem. I propose to extend the period of incorporation by 5 years to allow the benefit available to startups which are incorporated before 1/4/2030. In order to attract and promote additional activities in the IFSC, I am inter alia proposing specific benefits to ship leasing units, insurance offices, and treasury centers of global companies which are set up in IFSC. Further, to claim benefits, the cut-off date for commencement in IFSC has also been extended by 5 years to 31/3/2030. Category 1 and Category 2 AIFs are undertaking investments in infrastructure and other such sectors. I propose to provide certainty of taxation to these entities on the gains from securities, to promote funding from sovereign wealth funds and pension funds to the infrastructure sector. I propose to extend the date of making an investment by 5 more years up to 31st March 2030. Personal income tax reforms with special focus on middle class. Democracy, demography, and demand are the key support pillars in our journey towards Vikasit Bharat. The middle class provides strength for India's growth. This government, under the leadership of Prime Minister Modi, has always believed in the admirable energy and ability of the middle class in nation building. In recognition of their contribution, we have periodically reduced their tax burden. Right after 2014, the nil tax slab was raised to 2.5 lakhs of rupees, which was further raised to 5 lakh rupees in 2019 and to 7 lakh rupees in 2023. This is reflective of our government's trust on the middle class taxpayers. I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. So, average income of 1 lakh per month, other than the special rate income such as capital gains, under the new regime. This limit will be 12.75 lakh for salaried taxpayers due to the standard deduction of 75,000. slabs and rates are being changed across the board to benefit all taxpayers. The new structure will substantially reduce the taxes of the middle class and leave more money in their hands, boosting household consumption, savings and investment. In the new tax regime, I propose to revise tax rate structures as follows. 0 to 4 lakh rupees nil, 4.8 lakh rupees to 4 to 8 lakh rupees 5%, 8 to 12 lakh rupees 10%, 12 to 16 lakh rupees 15%, 16 to 20 lakh rupees 20%, 20 to 24 lakh rupees 25%, and above 24 lakh rupees 30%. To taxpayers up to 12 lakh of normal income, other than special rate income such as capital gains. I read that again. To taxpayers up to 12 lakh of income, other than special rate income such as capital gains, tax rebate is being provided in addition to the benefit due to slab rate reduction in such a manner that there is no tax payable by them. The total tax benefit of slab rate changes and rebate at different income levels can be illustrated with a few examples. A taxpayer in the new regime with an income of 12 lakh rupees will get a benefit of 80,000 rupees in tax, which is 100% of tax payable as per the existing rates. A person having income of 18 lakh rupees will get a benefit of 70,000 rupees in tax. That is 30% of tax payable as per existing rates. A person with an income of 25 lakh gets a benefit of 1,10,000 rupees. That is 25% of his tax payable as per existing rates. Details of my tax proposals are given in the annexure. As a result of these proposals, Honorable Speaker, sir, revenue of about 1 lakh crore in direct taxes and 2,600 crores in indirect taxes will be foregone. Mr. Speaker, sir, with this, I commend the budget to this august House.
Item number...
Well, I think the Finance Minister saved the best for the last, without doubt. On personal income taxation, there is a big announcement which has come. No income tax up to 12 lakh rupees under the new income tax regime. The entire slab structure itself has been changed. A new slab has been added as well. 1 or 2 new slabs have been added as well. And we'll have all of that up for you. Towards the end, the Finance Minister actually gave examples. She said that a person having an income of 18 lakh rupees per annum will get a relief of 70,000 rupees. And a person having an income of 25 lakh rupees will get a relief of 1.1 lakh in terms of their tax burden. So, I mean, that is essentially the announcement which the market has liked. On the macro big numbers, I'll toss to Lata in a bit, but the 4.4% fiscal deficit target, which she said earlier, that remains. We are still, of course, waiting for the Capex number for FY26, the budget estimate on Capex for FY26. But she's managed to provide some relief to the income tax payer, middle class, right at the end. And I think, as you can see, the market reaction as well, there was a steep sell-off when she began, and she kept that fiscal deficit at 4.4%, dampening hopes about how much relief she can provide. But of course, towards the end, I mean, that personal income tax relief which she has provided for income of up to 12 lakh rupees exempt, I think that has provided a bit of cheer to the market as well. And the Nifty is back up a little bit, still down from where it was pre-budget, but we're down about 0.15. But I think this is a lot of taxation-related changes, both on the direct side and indirect side as well.
I think we have to reserve our judgment. We have to reserve our judgment because she gave us the net tax income for the government, and she said that is going up from 25.47 trillion to 28.37 trillion, which is a rise of about 11%. So if you're cutting personal income tax and still this is up, we have to find out where
she's found the money.
there have been increases. As well, your expenditure has gone up by 7.4%. According to her, she mentioned total expenditure goes up from 47 trillion to 50.65 trillion. That's a rise of 7.4%. And you have got these tax reliefs. So is the Capex budget cut? We will have to wait to see that.
She said 1 lakh crore is the tax foregone on direct taxes. And I think there was a number on indirect taxes as well.
Which I missed.
Towards the end, I think tax
she said
foregone
about tax foregone.
Yeah.
But don't have the number. So my sense is maybe the Capex budget has been
it's a little subdued.
Has been subdued.
So it's finally a bonanza for the middle class because after a long, long time, you've got big announcements coming in. And not just on personal income tax, some of the bigger demands of the tax world, they have also been addressed. Let's start with personal income tax. Now, these are the rates that I could pick up, and we're just cross-verifying all the slabs because the entire slab structure has changed in the new income tax regime. What's the first headline? The first headline is that there is nil tax payable up to an income of 12 lakh rupees. The first slab is not starting at 12, but because of the way the slabs have been structured and the rebates, you don't have to pay any tax up to an income of 12 lakh rupees. This figure was 7 lakh rupees up until yesterday. That is, I mean, we're talking about the previous budget up until FY25. So 7 lakhs was the limit of nil tax. Now 7 moves to 12. So that's a big, big boost. The slab 0 to 4 lakhs, 4 to 8 lakhs, 8 to 12 lakhs, 12 to 16 lakhs, 16 to 20. There is 20 to 24. And the 30% rate now comes in only above 24 lakh rupees. So there's a sort of a big boost coming in over there. And then the rates come in 5%, 12%, 15, 20, 25. So this is what we have. We're going to cross-check some of the figures there. But this is what was, first glance, first hearing. This is what came out. So this is, point number one. The second thing that, a lot of homeowners will absolutely, like to hear is that the second house property that you have, which was subject to easier taxation only if you complied with certain very stringent provisions. Those provisions are getting relaxed. So not just one, but now 2 self-occupied house properties will get a beneficial tax treatment. They will be treated as nil value from a tax perspective. So again, this is a big boost coming in for those women who do have 2 house properties. That's the other one. The third major sort of relaxation or rationalization has come in the TCS and TDS regime, something which the industry was asking for many years. And one of them, which I remember because there was such a furor around this earlier, is the remittances that happen through the LRS route, where the cap was 7 lakhs. If you were remitting money above 7 lakh rupees, then a TCS had to be paid. Now that limit has been increased to 10 lakhs. So if Prashant and Lata are planning big foreign holidays with big packaged holidays, then there is a bit of a TCS and cash flow relief comes in. But I think we have a panel of experts. Let's actually get to them.
That was anyway set off with TDS.
Yeah, but let's actually get to the tax experts. Ashok, let me ask you first. So big bang for the middle class finally?
Yeah, I'm glad at last. For years, middle class has been waiting to see whether they get real relief. And I think moving the slabs up is really very, very good. I'm not sure I heard it right, but my sense was that the 30% slab applies only above 30 lakhs. But I may be wrong.
Above 24.
What we heard was 24 lakhs.
24 lakh.
Yeah. So I think at least up to 25 lakhs, it's serious relief. And she was computing the numbers and giving it to us. The question that Lata asked, which is a very relevant question, is that, if you're maintaining your fiscal deficit to the levels that you had announced, and you are foregoing 1 lakh crores in direct taxes, 2,600 crores in indirect taxes, and you are showing 11% increase in your tax collection, then where is the gap? We need to see the fine print to be able to see, where is the tax collection happening. But overall, I would say, from a middle class perspective, a fantastic budget, although corporates may be a little disappointed. There wasn't much that was at least spoken from a corporate tax perspective. But again, we'll have to look at the fine print.
Yeah, actually, on indirect tax, the amount foregone is only 2,600 crores.
Said right
so
now.
It's not a great deal.
If I can just ask Mr. Kanabar. Mr. Kanabar, you've been listening keenly as well. In the direct personal taxes, of course, is the big headline. But anything else you caught on the taxation front? Lots of announcements.
Actually, quite a bit, really. And sort of, just before the budget, we spoke about ease of compliance and quite a few things. Like, for example, there was this regarding safe harbor rules being extended. And of course, nobody cheered it up in the House of Parliament because this is not a subject which people would normally understand. But that's going to be something which will ease the compliance burden of multinationals, will promote a lot of foreign investment. Similarly, tonnage tax being applied to domestic vessels. Again, something very, very welcome. And then a few other things. So, for example, charity, if you are recognized, rather than renew every 5 years, you would renew every 10 years. You are permitted to update your return for 4 years. Each one of them may appear to be small things, but they were really irritants. And sort of their going out is going to be something which is very, very welcome. I think it's quite a bit really.
Well, that's the budget Nirmala Sitharaman has delivered, saving the best for the last. As we've been pointing out, this has been the big ask, the big expectation, the big hope, and the finance minister delivering. As the prime minister said, the focus this time around was going to be on the Madhyam Varg, or the middle class, and that is what the tax slabs that have been introduced in the budget have taken forward. So up to 12 lakh rupees, as we've been pointing out, no income tax is payable, and of course, new introduction as far as different slabs are concerned, and the 30% kicks in above 24 lakh rupees. But it's consumption that seems to have been the focus of this budget. We're still waiting for the fine print as far as the Capex number is concerned. The revised estimate comes in at 10.18 lakh crore rupees. What is the BE? We need to know. But it is consumption that the government has gone for as part of what we are seeing. Let me very quickly bring in a take there from Madhu Kela. Madhu, FMCG stocks on fire at this point in time. It's a consumption boost that was being hoped for.
Yeah. Sireen, this is a big one. I think getting to 12 lakh rupees, I don't think anyone in the market was expecting this. So this is clearly a big one. And I have the Capex number. It is 11.21 lakhs crores. So essentially, even the Capex number are in line with what the market would have expected, from 10.2 to 11.21. And fiscal deficit, again, 4.4% next year. So I think they have met all the numbers which was guessed by the markets. I think it is on the better side only than what market would have assumed before the budget.
Okay, so 11.21 lakh crore rupees, that's the Capex number, Madhu Kela, that you're giving us. That's coming in from the budget fine print. So as you're saying, the expectation was, or the hope was, between 12 and 14 lakh crore rupees. The government coming back with a number of 11.21 lakh crore rupees. So it is an improvement over what was the allocation last time around. Remember, 11.11 lakh crore rupees, so a slight improvement there, but an improvement over the RE. Disinvestment and monetization target has been kept at 47,000 crores for FY26. FY25 RE at 33,000 crores from 50,000 crores in B. Again, along expected lines, we've seen this happen on the disinvestment front time and time again, and that's what seems to have happened even as far as this year's budget is concerned. 11.2 lakh crores is the Capex number. Very quickly, let me bring in our guest, Zia Modi. A quick take, the big headlines for you from Budget 2025.
Thank you. I think from my perspective, the now formalization of the insurance FDI to 100% is good news. What is even better news is the finance minister's commitment to revamp the KYC norms in 2025, which has caused a lot of pain in the ease of doing business. I think that the IBC, I was looking forward to some announcements on pre-packs or cross-border IBC situations. Maybe that will come later, but that is very important because that law has clearly brought down our NPAs. The enhancement of the judiciary, the dropping of government taking cases to court. Government today is our biggest litigator. Maybe there will be something in the fine print to show that unnecessary litigation can be cut down, especially since the FM has said she's digitizing faceless assessments, etc. I think that the one thing that stands out, which I'm hoping to see some movement from the government, is a liberalization of Press Note 3, which is the bordering countries, which has had a lot of unintended effects and slowed down FDI from private equity. But all in all, I think the message of getting out of the way, to stop micromanaging, to listen to the industry and to allow the theory of being honest unless you are proved dishonest, are all very, very positive messages.
Yes, positive messages. And speaking of positive messages, we're still going over the internals now, because remember, as the finance minister was pointing out, a lot of the details there in the annexure, not in the speech. More good news, the tax deduction limit for senior citizens has doubled from 50,000 rupees to 1 lakh rupees. So more sweeteners they're coming in. The tax deduction limit for senior citizens has been doubled from 50,000 rupees to 1 lakh rupees. We will have to wait to see under whether that's under Section 80D, but we'll get to that. Let me bring in our other guests as well. We've got plenty with us here. Before I get back, Madhu, a quick take on the markets from where we are before we get the other voices in.
Yeah. Serene, I think from a market perspective, I would like to mention one thing. There is a lot of emphasis on ease of doing business, decriminalization of laws, and making things really, really simple. Apart from increasing the personal taxation slab. One more thing, she spoke about the introduction of new income tax bill, which is to be tabled next week, and which will basically deregulate a lot of things. So this will be perceived very, very positively, and it's a basically continuation of the good effort. From a market perspective, shouldn't we are back to back to basics? I think this will be a range-bound market this year, and this will be stock pickers market. So if you can really take advantage of all this volatility which is there and pick up good companies, that's where money will be made.
I mean, absolutely. By the way, as you said, the volatility is back, right? We were up, we recovered after that personal income tax announcement. We're down about 50-60 points on the Nifty once again. Prashant Khemka is with us as well. Prashant, do you think this will, by the way, the Nifty FMCG index is up some 3%, Maruti is up 6%. More money in the hands of the middle class. Where will they spend it, in your assessment? And as a money manager, what looks best placed?
See, I think overall it is positive for the market. As Madhu just pointed out, the most important thing to me is that there's a genuine intent and effort. It comes through very clearly to increase the ease of doing business. So it's directionally very positive. There's no material negative. I usually, when I'm sitting and hearing the budget, I keep tab of the positive snippets and negative, and there are hardly any on the negative side. Whereas on the ease of doing business, the underlying spirit of the budget is to simplify rather than to complicate things, which is often the problem with budgetary speeches. So be it 100% FDI in insurance, simplifying TCS, TDS, or decriminalizing additional 100 laws, safe harbor rules, as mentioned earlier by Mr. Kanavar, I believe. So a lot of the, obviously, fine print needs to be still seen. But all sounds very positive. And most importantly, the finance minister mentioned the new income tax bill, which is scheduled for next week, would be, in her words, it would be clear, simple to understand, and provide tax clarity. That would be a big boost to overall business environment, and that can only be positive for job creation as well as for the markets, broader market. So if there is additional savings in the pockets of middle class, I think the market, rather than selecting a particular sector, I think it should be positive for the broader Indian market.
Okay, gentlemen, I just want to come to a couple of additional announcements that we haven't heard so far. They're all from the budget documents, and these are perhaps going to be very welcome by the financial services sector, and I'll get to the experts in just a bit. For GIFT City, there is a boost. It is proposed that transfer of share of unit or interest held by a shareholder in the original fund in consideration for the share or unit or interest in a resultant fund on relocation shall not be regarded as a transfer for the purpose of calculating capital gains. There was an ask that if a fund or a structure is relocating from a foreign destination to IFSC GIFT City, then give it some tax relief from the point of view of capital gains, and that seems to have come through. And one more, the extension of the date for sovereign wealth funds that are investing in the India infrastructure sector. There was a sunset, but now look at the extension. Instead of March 2025, they have extended it all the way to 31st of March 2030 to attract long-term capital in the infrastructure sector, perhaps. So if I could go back to the panel, Mr. Kanabar, your thoughts on some of these internals that are arising from the next years?
Both of them very, very welcome. This
Absolutely.
was something, a very, very specific ask.
Yeah.
Clearly, investment into infrastructure is something which is long gestation. There is no point in tinkering it year on year, and giving it a 5-year thing is something which is very much welcome. Similarly, the proposition is that if there are funds with investments in India and they are relocating into the GIFT City, then there should not be a tax implication. Again, that has been accepted. Both very, very welcome. Similarly, there is this whole provision that if your transfer pricing is accepted, it is accepted for a block of 3 years. Again, will make not a lot of non-residents relocate India and come back to say the transfer pricing litigation will come down. All very, very welcome.
Okay. No, that's good to hear. Actually, I have some problem perhaps with the confidence. Corporate tax growth, according to the BE for the current year, works out to 7.5% higher. For next year, the estimate is that it will rise by 10.5%. So we keep our fingers crossed over there. One expects that corporate sector has to do better, but obviously that is the estimation. But otherwise, the estimations are very modest. For instance, income tax this year, it is up by 22% as of December, for which we have data. They have estimated only 20% higher for the full year. But for next year, the estimate is only 14.4. Clearly because tax rates have come down. So the estimates seem modest when it comes to income tax. Corporate income tax, I hope we deliver on that 10.5. But I think within this, in spite of not assuming very aggressively, they have been able to give a capex of up by about 10%. So that's very good. Yeah. Prashant, can you tell me why the market is sulking? It's got its tax cuts. It's got nothing negative in terms of capital gains. But actually, there's red on the screen. Bank Nifty is down about 0.5%, 0.6. Anything that's niggling the markets at all? Prashant, and then I'll come to Madhukela on that.
See, hard to say with markets 0.5% here or there. But if it was me, I would read this as a positive. And I would think if I had not seen the market ticker, I would have expected the market to be positive today by a percentage point at least, because the absence of any negative itself is a big positive. And then as we were talking earlier, there are a lot of, absent the fine print, still a lot of directionally very positive announcements, the 100% to FDI, 74 to 100%. In and of itself, none of these measures may be big enough to have a positive impact. But when you view them collectively, it shows the direction in which the government wants to take it.
Actually, it's I think the defense stocks and the railway stocks that are going down, because I guess something specific was expected on defense. But otherwise, FMCG stocks, consumption stocks, all the trends, the Britannias, the auto stocks, Bajaj Auto, all of them are up and about. Maruti Suzuki's numbers also have been good for December. Mr. Dinesh Khara is also with us, former chairman of State Bank of India. Mr. Khara, the borrowing has been kept almost as expected. It's about 14.8 trillion. I think the market expectation was 14.5. But the fiscal deficit is lower than expected at 4.4%. What do you think you can expect? Rate cuts now? Good times for banks?
I think it may or may not have any impact on the rate cut, but just it certainly reflects that what is the government thinking. And so long as fiscal is kept within check, certainly it is an indication that inflation will also remain under check. That is what I would like to add. And also I would like to mention when it comes to various sectors, particularly what is talked about in terms of the income tax, personal income tax, it is going to spare a lot of liquidity with the middle class, which will certainly spend. Likewise, when it comes to agriculture also, the KCC limit has been increased. Similarly, when it comes to MSME also, they have increased the guarantee cover, and similarly for the exports. So I think these are some of the sectors which are eventually going to have the mainstay when it comes to the economy.
Right.
So I think on these very parameters, it really augurs very well when it comes to the economy overall. And the kind of challenges which we faced in the last quarter numbers, they are very well being addressed through this budget.
Got it.
The point
Sajid
taken about MSMEs, I think what the chairman is pointing out is very well taken.
Sajid is with us as well. He was with us right before the budget speech started. Sajid, what did you make of the big macro numbers? All in line?
Very much in line, right? This is following the rhyme and rhythm of previous budgets. I think conservatism is the needed was the buzzword here. The deficit number is very similar to what we thought. 4.8 goes to 4.4. Nominal GDP assumed quite conservatively at 10.1%, to this year is below 10. And the question was, and we had also said that Capex to GDP would remain in line with what is achieved this year, and that's panned out as well. Capex is rising in line with nominal GDP. I guess the question was always, where was the consolidation going to be achieved? Would it be on the revenue side or the expenditure side? It's largely on the expenditure side, and it's happening on non-capex expenditure. So there's some expenditure restraint on revenue expenditures. The other one point to keep in mind is on tax buoyancy. Once you adjust for the foregone revenues from the tax cuts, the budget essentially is assuming a tax buoyancy of 1.3. Okay. Now, this year we got about 1.1. So we'll wait to see if that's achieved. But I think no major surprises as far as the big fiscal math is concerned.
You know, the GTR, gross tax revenue, is assumed to rise by 10.8%. And nominal GDP by 10.1%. So it doesn't look like it's...
No, well, because, Lata, you have to adjust for the foregone tax revenue, which is 1 lakh crore from the tax cuts.
Yeah.
So when you adjust for the foregone revenue, then what you're assuming is the effective growth in gross taxes is 13% in a nominal GDP of 10.1.
Okay. Well, we have Anish Shah also with us. Mr. Shah, what have you made? The auto stocks are up and about.
One is a demand stimulus that was much needed and very well delivered. Second, a focus on making India the manufacturing hub of the world. The focus on ease of doing business, on enabling capital goods to be imported at lower rates, and importantly, addressing the duty inversion that we've seen. These are all things that will help make in India in a much more significant way. And the third is inclusive development, which is also something that is important for us as an economy. So on balance, a very good budget. The Capex from a government standpoint stays on course, which is something that we ideally would have liked. And the fiscal discipline stays on course as well.
Well, that's right. The fiscal discipline stays on course. Capex, along clearly what the economic survey as well as the CA were highlighting would be the trend as far as Capex was concerned. But then you can't have Capex and the consumption boost at the same time. So the expectation of doing 20-25% on Capex and then also providing income tax relief, which has been the big focus of this budget, can the two be reconciled together is the big question. So the government this time around has prioritized consumption and relief for the middle class. And if you just bring up all of those stocks, FMCG stocks at this point in time, the new age stocks, Zomato and Swiggy and all of the others, and Mangalam is standing by with a rundown of everything that's moving. That side of the market clearly is firing at this point. But let me bring back our budget editors into the conversation as well, Atanu Chakrabarti and Rathin Roy. Mr. Chakrabarti, to you first. As far as the big numbers were concerned, pretty much steady as you go.
Yes, very much in a sense that the borrowing numbers satisfy the requirement of I was looking in containment, they have actually gone in for reduction. So even if numbers don't hold at the end of the year, still the borrowing numbers, the gross borrowing numbers are lower than last year, assuming a fiscal deficit at 4.4%. Yeah. RE is at 4.8%. So a good glide path there. Consumption, Philip, given through, as you just mentioned.
Were you expecting them to go as far as they have? Or has it surprised you on the positive side?
Frankly, no. I am pleasantly surprised and very happy about it that the fiscal reduction, debt reduction is, because that opens up the credit growth for the industry in general, which has been sort of accounted for in a lot of expenditure proposals. They're depending upon bankable schemes.
Right.
So unless you open up that space and crowd out, you are not going to get that. So there is, I can see a design in the entire thing, that fiscal reduction, which was important, and that builds upon a lot of bankable schemes that have come.
So Ratil Roy, they have delivered on the 3 C's that we were talking about. Capex, you can argue about whether they could have done more, but more importantly on consumption, they've clearly delivered more than what the market or even the consumer was hoping for. And even on consolidation, they've stuck to the glide path.
Yeah, well, I was not expecting them to not stick to the glide path. I was not at all sure whether the government would engage in yet another round of wishful thinking. Quite frankly, I think the execution capabilities of this government, as far as Capex is concerned, has hit its limits at 11 to 12 lakh crores. Now, the point is to try and promote Capex in the private sector, where the real execution capability is. Looks like this is what the government has in mind.
Yeah.
But I'd like to puncture one balloon. Everyone here that's come on your program so far, me included, is in the top tax bracket. And everyone who pays tax in India is in the very rich part of the population. It is facile to call them middle class. So what has happened is, at the cost of 1 lakh crores to the exchequer, which is a small price to pay, is a major increase in the regressivity of our income tax system. Till yesterday, you had to earn 3.5 times the per capita income to start paying income tax. You will now have to earn 6 times the per capita income, 6 times the per capita income to start paying income tax. So by no stretch of the imagination can we say that these people who begin to pay income tax at 6 times the per capita income belong to anything other than the top 5 or 10% of the population. So that regressivity has come at what cost? Well, it has come at, the tax system has become more regressive because if you look at the indirect tax burden, it's the same. So you have the progressive part of the tax system, which is direct taxes, is now nicer to the rich people. The indirect taxes, where the burden is shared between rich and poor, remains high. And therefore, what ends up is the proportion of taxes relatively poor people who don't pay income taxes but do pay indirect taxes is now greater. So this is, in that sense, on the tax side, a regressive budget. It will increase consumption of you and me. It is going to do nothing, absolutely nothing, for consumption of the Aam Aadmi.
Okay. Well, we'll have to wait to see, but the market reaction at this point in time is 2 thumbs up. Manglam, very quickly, run us through what's happening on that side.
Well, it is a consumption budget, Shireen. Tell you, no income tax payable up to 12 lakh rupees, income of, up to 18 lakh rupees, saving 70,000 rupees, and income of up to 25 lakh rupees will save over 1.1 lakh in taxes. What does this do? A shot in the arm for all the urban consumption names. So we have, names like Jubilant Foodworks, Zomato, Trent, D-Mart, the ones who have a higher propensity of revenue coming in from the urban centers doing extremely well. No tinkering on taxes for all the sin goods. Those stocks also doing extremely well, and some support coming into rural and agri names has a positive impact on larger FMCG names as well. The FMCG index had been underperforming. The street was hoping for some sort of shot in the arm coming in from the budget to consumption. The government has gone ahead and made its 2 steps. Now the rest remains on the FMCG industry to go ahead and deliver those growth numbers. Most of these stocks are actually trading very close to their 10-year averages as well. So from a valuation standpoint as well, this budget has a trifecta of all positive news coming in from the consumption sector. And we're seeing that in names like Jubilant Food, Trent, ITC, all of them being among the top gainers in today's trading session.
They certainly are, but let me go back to Anisha before I let him go. Anisha, in what way does what has been delivered today change the needle? Do you believe, as far as private investment is concerned, that's been the big hope and the big ask in terms of consumption as well? And also from a manufacturing standpoint, the measures announced by the budget, including on the customs side, on each of these 3-pronged areas, how does the needle move post the budget?
I think it just accelerates our pace, Shireen, because the fundamentals have been very strong in the economy. We've seen short-term blip from a demand standpoint. With the consumption incentives given here, hopefully that is addressed. The more important thing is to ensure that we can manufacture in India at a much lower cost than the rest of the world. And that will allow the economy to grow at a much faster pace. And a number of measures taken here are steps in the right direction to make that happen.
Okay, got that point, Anish. By the way, I just want to point out, trying to go through more and more of the annexures. So while the budget speech spoke about the reduction in TDS thresholds for certain segments, for instance, the LRS limit 7 going to 10 lakhs, there is an increase in TDS rates or the thresholds for a whole range of payments. Dividends for an individual shareholder, income in respect of a mutual fund from a specified company undertaking, winnings from lottery, crossword puzzle, winnings from horse races. So there are several cases where the thresholds have been increased. So that's what we have at this point in time. I just want to go back to the panel here and, Sunil, if I could come to you, what is the big picture takeaway? The headline clearly seems to be that the middle class has finally gotten the relief. But one ask, at least I have not found even in the fine print so far, which is corporate India was asking that new manufacturing companies should be given more relief, that concessional income tax rate of 15% should be brought back, if not 15-18%. But as of now, we've not seen evidence of that in the speech or in the documents. Your overall take on what this will mean once we go beyond the personal income tax bonanza?
So thank you for having me. So I think, Surbi, a lot of eyeballs and discussions is obviously pertaining to the income tax relief, and rightly so. The government has given 1 lakh crore in the hands of crores of Indians, and that is a welcome step because I think the economy was suffering from low consumption, a combination of obviously maybe less disposable income as well as tight liquidity situations. So the liquidity situation was eased off a little bit 3-4 days back when the central bank pumped in 1.5 lakh crore, and now this 1 lakh crore additional also has the potential of at least kickstarting a little bit of a temporary blip in consumption. Having said that, I think capital expenditure, which was slated to be 11 lakh crores, the government has not been able to spend the entire amount, maybe because of inflation, everything got deferred. And to that extent, the kickstart as far as Capex is concerned has got deferred a little bit. Luckily for next year, we are again looking at a 10% growth on this lower 10 lakh number. And I think that is something which is very interesting and is very, very needed. As far as your comments are concerned, I think a lot of announcements were made in terms of, pushing in manufacturing in India, particularly, industries where it's more smaller industries, SMEs, where there are a lot of imports, a lot of manpower required, like textiles or leather or toys and so on and so forth. So I think the intent is very clear that we need to make India a powerhouse in terms of manufacturing also. We still have to see the fine print.
Yeah.
But on the face of it, obviously, this 15% has not been revised. But on the infra side, I think there has been a 5-year extension in terms of fresh investment, which will
Absolutely,
be
the sovereign wealth funds.
its benefit. So I think it's a good balance. I think overall, it's a very balanced budget. I wouldn't say it's like a superlative growth focused budget, but this 1 lakh crore of added income in the hands of crores of Indians, I think that's a key positive.
Yeah, absolutely. And I just want to add to that the annexures show a whole range of announcements to make GIFT City more attractive. Again, that's a stated roadmap to try and get in more longer-term capital through that route. In fact, let me answer. And one more point we should keep in mind on crypto, by the way, there is a clear reporting framework that has been announced. It says there is a proposal to bring an amendment in the Act for this new reporting framework for all regulated entities, which would be crypto exchanges. They have to give information on digital virtual assets in a specified format as the government asks for it. So that's one. But comment on this point, if I could throw this to Ashok and maybe to Dinesh as well. Ashok, coming to you first. While, visibly we don't have that headline on 15% tax for new manufacturing companies, I don't know if you had a chance to go through some of the GIFT City provisions or the other provisions, sovereign wealth funds we've spoken about. Do you find anything else there that could excite longer-term investors looking at India?
I'm actually just looking at the fine print. It's just been delivered to me. And there does not seem to be anything which is specific. I mean, obviously, we've all spoken about the infrastructure. We've all spoken about the one question that's still unclear is that if a domestic fund, in other words, if a fund from India was to relocate to the GIFT City versus a global fund being relocated to GIFT City, whether the relocation from India to GIFT City also triggers the same benefit or not. That's not been clarified in my view. Where there's clarity about global funds being relocated to GIFT City, there is clarity.
Yeah.
I haven't been able to pick up whether, if for example, a normal fund an AIF was to decide to relocate to GIFT City, whether that capital gains would be exempted or not. Haven't got that done. But there is language around parity on long-term capital gains on transfer of securities between residents and non-residents. And, there was some lack of parity when changes were made last year, both in terms of property as well as, of course, in securities. And I think they seem to have brought that parity back. That certainly seems to have been provided as a clarification. But over to Dinesh for that.
I just wanted to come in with some of the sectoral outlays, guys, and maybe we should just bring up these numbers for the benefit of all of our viewers. The defense sector outlay has seen a reduction at 4.91 lakh crore rupees. The budget has allocated 4.9 lakh rupees for the defense ministry. That's down from 6.2 lakh crores in the July 2024 budget. So that's as far as the defense allocation is concerned. At 4.9 lakh rupees for defense, down from 6.2 lakh crores in the July 2024 budget. Rural development, an outlay of 2.6 lakh crore rupees. Agriculture, 1.7 lakh crores. Education, 1.28 lakh crore rupees. Health, 98,311 crores. Urban development, 96,777 crores. IT and telecom, 95,298 crores. We'd have to also see whether there is an enhancement or a reduction across, but defense, there is clearly a curtailment as far as the outlay is concerned at 4.91 lakh crore rupees versus the 6.2 lakh crores. You wanted to come in, Ratin?
No, I just wanted to say that one good thing in this suit boot budget, which should help all the suit boots who are celebrating this so-called middle-class tax cut, is a very promising announcement the finance minister made, that she's going to cut the tax code in half. That's been long overdue, long overdue. And much as I might be, sad at the celebration that's going on about this, people earning 6 times the per capita income getting a tax break, lowering the tax code bill, I think, should incentivize the growth in taxation. I also want to caution about the numbers for next year. The implicit buoyancy of 1.3, 1.4 that is implied in this budget is very rarely achieved by government, especially at a time when growth is tanking. So this particular cut, although the absolute amount is only 1 lakh crores, might actually put pressure on government outlays. On defense, I want to say, I think the government has been very realistic. They are unable to spend on defense. So there's no point allocating money for defense when you can't spend any money. And I think the government has done quite the right thing to make it more realistic for next year, because they have a good idea about how they're going to be able to allocate money to defense next year. So all in all, I think on the expenditure side, the budget has been prudent, and therefore you're seeing more modest outlays, because the execution capability of the government is limited. And it is for that reason, and not because of the tax cuts, that the expenditure side looks, moderate.
Fair point, and that's an interesting and important point that you make as far as the defense sector allocation is concerned. Mr. Chakrabarti, you've been going over the fine print. Anything there, and especially as far as the housing sector, etc., is concerned, cement, steel, what do you believe that the budget does in terms of infrastructure, housing specifically?
Three things. For defense first, I guess we need to, because these are reasonably finely balanced. So perhaps we have to see between the revenue allocation, because revenue was about 3 lakh crores, balance about, so it was about 4 point odd something. Right. So I'm a bit surprised when we say 6, because there are some other allocation for roads, etc., which keep changing. So I guess a fine print needs to be seen. This is unlikely. There's not much of a scope for cutting, because almost 75% of the capital acquisition in any case is domestic. Correct. So therefore, the numbers are reasonably well known. So that's one particular thing I'm happy about is about IFSC, which we just discussed.
The GIFT City,
A, income tax, B, getting AIFs in. Because if you see, the corporate tax is at 9.8% growth. Less than 10.8% envisaged, 9.8 lakh crore, about 40,000 crore less than what was envisaged at B stage. It has not really kept up pace. So the only disruptors in the economy are going to be the startups and GCCs, where there's a lot of private equity movement, which could happen only through IFSC. To that extent, one again has to see the fine print of regulation and everything. but at least a correct direction on the things to come.
Correct direction. And of course, as we've been pointing out, we are poring over the fine print at this point in time because the speech did not focus on the details which are available in the annexures. But let me toss it back to you in Bombay.
Shireen, thanks very much for that. You know, I'm just looking at the market and I don't want to sort of put everything which is happening on the budget. I mean, after all, it's for Saturday as well. So we must keep that in mind. But FMCG, of course, the index is up almost 4% now. So if anything, it's picked up a little bit more steam. And the auto space is up about 2% as well. On the other side, defense, as you said, Shireen, in terms of allocation, sharp deceleration, right? The index is now, there's a Nifty defense index, it's down 3%. And the PSC, CPSC, a couple of these government company indices, oil and gas, they're all down between 2 and 3% at this point. The metals index is down about 1.8% as well. And IT as an index is down about 1.5% as well. I just want to go back to Sunil for a bit. Sunil, with this sort of 1 lakh crore boost to the, the taxpayers, as an investor, does it make you any more bullish directionally to look at that area? There is on this Friday, we'll have something from the RBI as well, maybe a rate cut.
So I think, Prashant, last 1.5 years, consumption generally has been pretty slow. Combination of maybe a little bit of inflation, maybe a little bit of fatigue post the huge boom we saw in the consumption post-COVID and so on and so forth. I think a little bit of liquidity squeeze also from NBFCs and banks in particular post the regulator directing them. So I think all this is getting sorted to some extent. On the fundamental side, we have had good monsoon season, good crops. I think crop prices are good. So the rural income should be pretty handsome or should see a pretty handsome growth. You had RBI, which infused 1.5 lakh crore only a few days back. So liquidity has been to some extent taken care of. And now we have this huge boost of 1 lakh crore flowing into the hands of Indian consumers. So I think at the margin, obviously, yes, there will be some move up as far as consumption is concerned. However, what is happening on the consumption stocks is a combination of a lot of things. One is they have never been cheap. They are not cheap. So there's a valuation headwind. Second, there are a slew of new products coming in, and particularly with this advent of digital economy and D2C brands and so on and so forth. To some extent, there's been a cannibalization, even in terms of existing players losing some market share. So I would say that at the margin, this is positive, but this is not something which would lead, an investor to double or triple the weightage as far as consumption is concerned. Maybe, a slight tweak. But for the economy, I would say it's a bigger boost because the economy needs consumption as well as Capex to move back to that 6.5-7% nominal and real and 10% nominal growth rate. Rate cut, I'm not sure whether it's going to happen very soon. But the good thing is the path to fiscal prudence is maintained. And to that extent, the environment as far as interest rates in India is concerned is pretty, on the downside, which is refreshing compared to what is happening in the world.
Okay. Well, point taken on the consumption boost. And I also take Ratin Roy's point that, that also means that there is that much less in terms of welfare expenditure. You cannot take away from the fact that we have a very large number of people who are not earning even 6 lakhs, forget 12 lakhs a year. But Mr. Dinesh Khanna, to come back to the fact that there is more money in the hands of those who would take retail loans. 12 lakh rupees is the minimum income tax limit now. Does this mean that banks can now have more of a retail loan, or do you see the Capex baton being picked up at all by private sector, given what the budget has said?
No, I think there is a very clear focus when it comes to the infrastructure investment, and also they have brought in the PPP concept also. So I think part of the infrastructure also, they have also indicated that even state government are expected to join them in this PPP investment for the infrastructure. So I think infrastructure boost will certainly be seen. And when it comes to the retail borrowing, maybe, there are, of course, when it comes to the consumer unsecured borrowing, that is expected to remain expensive. But nevertheless, I think as far as home loan, etc. are concerned, there will be enough disposable income to support the EMI. I expect that even that sector will get a boost with this kind of a income tax relief which is seen. And also I would like to mention that, now the startup also, they have increased the guarantee scheme for startup as well. So I think to that extent, they are addressing all the very critical components which are required to be addressed for giving the required push to the economy.
All right, got that point, Mr. Khara. Just going back to Dinesh. Dinesh, earlier, I asked that question to Ashok as well. Let me take that to you now. Whether there is anything further that you've picked up in the annexures in the fine print. There are lots and lots of announcements on GIFT. One, we discussed, but like Ashok was saying, that there still needs to be clarity whether there is a domestic relocation from, anywhere in India to GIFT, whether that also gets a capital gains exemption. Anything else which could boost investments and flows?
Lots and lots of things. So far as GIFT City is concerned, income arising by way of ship leasing is specifically exempt now. ETFs have been brought under the ambit of what can be done in the GIFT City. One very welcome thing which one has seen this time is that most of the extensions are for a period of 5 years rather than 1 year, which you see at a time. So for example, the income of a startup is exempt for a further period of 5 years straight away. So up to 30, whatever startups are there, 5 years exempt, which is again a very, very welcome thing. One very interesting change, and the finance minister did mention this in her speech, but I didn't pick it up at that point of time. There is this concept under Income Tax Act that if a foreign company has a significant economic presence in India, then it is liable to tax in India. This, of course, applies where there is no tax treaty. And the question is that if the significant economic presence is only for the limited purpose of export, would there be a tax liability? And that has been clarified, and that should provide a relief to several people because that was something which was acting as a barrier to exports. So again, very, very welcome. So quite a few clarifications out there.
All right, Mr. Kanabar, we'll come back to you, sir. Let me bring in Amitabh Kant. He joins us now. Mr. Kant, always a pleasure. Many thanks for joining us here on CNBC-TV18. She saved the best for last. It is a budget that's delivered on the hope of boosting consumption, on delivering for the middle class, and that was the promise that the Prime Minister had made. On balance, Mr. Kant, your big read, your big takeaways from Budget 2025.
So, Shireen, first and foremost, I'd say that the main attempt has been to give a fillip to demand and put more money in the hands of the consumers. That should give it a big push. But it has been done in a fiscally responsible manner. She's also looked at the macroeconomic stability of the economy because 4.8% fiscal deficit in the RE and aiming at about 4.4% for the coming year. Also, I think if you look at the budget, there's a huge focus on labor-intensive sectors. The first time I've seen so much of emphasis on tourism, on textile, on footwear. So labor-intensive sectors, there's been a focus, but I was particularly glad that the startup fund of funds has been replenished by another 10,000. This will have a huge multiplier impact because there'll be a risk sharing with the venture capital funds. And also this putting another 20,000 crores for innovation and saying that there'll be a separate fund for deep tech areas, which requires patient capital. So that should be a big push to the startup and the deep tech movement in India, which is job creating in many ways. And I would also say that two good things that have happened in the budget is that, I'm a great believer in free enterprise and private sector. The focus of taking asset monetization forward from 6 lakh crore between 21 to 24, now to 10 lakh crore. And that means asking government departments that put out your assets for monetization and private sector to come in and do better operation and maintenance. And secondly, to ask every ministry, prepare a pipeline for PPP projects for the next 3 years because the government departments were getting very comfortable by owning and managing infrastructure. And that was causing great inefficiency in the economy. So putting all these out and bringing in greater thrust to PPP will be a very good thing. The total allocation for infrastructure on Capex has been kept at about 11.2 lakh crores, which is a little higher than the previous time. But infrastructure, greater thrust on execution and implementation of infrastructure projects is very, very critical. I would have felt that there should have been a much greater even a greater emphasis on infrastructure because infrastructure boost gives a long-term impact. And lastly, I feel that there is a clear realization in government that several departments and regulatory bodies have caused a regulatory cholesterol, and they need to scrap rules, regulation, procedures, and acts all over. A huge amount of scrapping of laws, etc., needs to take place. And rightly, the finance minister has talked about laying a huge emphasis on ease of doing business and creating a committee which will come out within 1 year, a report. I think it should be much quicker, much faster, because at the state level, a whole range of deregulation is necessary and is required. And this, to my mind, is very critical. And I also feel that this emphasis on clean tech mission is very important because today, if you look at it, solar, we are importing 80%. EVs, batteries, we are importing about 75 to 80%. All these things require an approach of Make in India in a very big way. And so overall, I rate the budget as giving a major push to demand creation in the Indian economy, and a very macroeconomic stability is really the focus despite this big giveaway of 1 lakh crore.
Yes, it is a big giveaway in terms of the revenue foregone for what the finance minister has delivered as far as direct taxes are concerned. But Mr. Kant, this regulatory cholesterol that you spoke of, and of course, a lot of what was announced in the budget will be work in progress. As you pointed out, a committee will now look at these areas of deregulation and so on and so forth and come back within a year's time. But on the infrastructure side, because you said that you would have hoped for the government to do more. At 11.21 lakh crore rupees, the Capex, do you believe that is enough? Do you believe more should have been done?
Yeah, but the intention, again, Shireen, is that you have better quality of infrastructure creation with 11.2 lakh crores, but you also push out a lot of government assets for private sector management through the asset monetization pipeline. Which has done well. They were able to achieve the 6 lakh crore and now to target for 10 lakh crore. And also say that we are going to have more and more of PPP because in the last 7-8 years, there's been a slowdown on the public partnership projects, and that requires you to do a lot of homework in terms of land, your ability to get all clearance and then put them out for bidding. So you need, every ministry has been asked to do this in the next 3 years. That, to my mind, is very important. It's a clear message that the government believes in private sector and it believes in private sector management of infrastructure creation. That's important. I really feel that the next bid round is the fiscal bid has been done, and the next bid is to allow, in the monetary policy, to allow greater credit to flow, because I'm a great believer that the private credit to GDP ratio in India is still low at about 50%. That needs to increase, and the RBI needs to pick up the baton and allow greater credit to flow to India's budget.
Right. Okay. Shireen, I just want to quickly make a mention on what's happening to insurance names, and they're all up on your screen right now. HDFC Life is down. These are big moves. 6.5%, 6% on HDFC Life. Max Financial is down 4%. ICICI Pru is now down 7%. And you can look at something like a SBI Life, which is down about 6.5%. It's not something which has been done for insurance, or there's no negative per se for insurance as a space. It's not directed at insurance. It's just that the new tax regime has been incentivized. heavily in a big way, and this will make, I mean, the no tax up to 12 lakhs will make a lot of people think to move. The thing is, under the old tax regime, under the sort of, 80C benefits, etc., insurance gets a fair bit of relief, tax reductions. And if people move from the old to the new, I think that essentially is the reason why these insurance companies are selling off. I saw estimates ranging from about 5 to 7% of individual new business premiums on account of this 80C benefit. So it's not that large also, but at the margin, it's certainly negative. I think Yash is with us for a quick take. Yash, over to you.
Well, Prashant, I want to explain two things. One is, of course, the obvious question that if the government is going ahead and increasing FDI to 100%, why are life insurance companies or insurance stocks reacting negatively? Let me clarify that first. FDI going to 100% has no impact on the listed companies, because what comes in the way there is the minimum public shareholding norms, where the promoter can only have 25%, 75% have to be in public. So, of course, FDI of 100% does not matter at all as far as the listed life insurance companies are concerned. So, there is no positive coming out of there for the listed life insurance stocks. Then why are they down today? That's exactly what you were also alluding to. Government's move to sweeten the new tax regime. Now, of course, as per the new tax regime, if an individual plans to take exemptions, which the government plans to introduce under the new tax regime, then there won't be any tax payable up to 12.75 lakh. Now, what that creates the fear is that more and more people, if the new tax regime becomes beneficial to them, will look to move towards new tax regime. And what that does is that it defeats the purpose of buying life insurance or health insurance for the intention of saving taxes under 80C as well as under 80D. You spoke about the estimates, about 5 to 7% of the life insurance premium still comes for the intention of tax saving under 80C, and that is the impact which might get impacted for life insurance companies as well as on the 80D side for health insurance companies if people indeed find the new tax regime more beneficial, more attractive, and start moving there. And that's exactly the fear which is rattling the life insurance stocks particularly today.
Yash, I just want to make one, you said FDI is not negative. It wanted people, biggies come in with 100%, won't that raise competition?
So, Prashant, it is positive for the sector because, of course, a lot of foreign capital, a lot of capacity with that would come.
No, I'm saying from if you're already an incumbent large player, it raises competition, right, at the end of the day?
Correct. It will increase competition, but, I mean, with a penetration of 3%, insurance density of just $92,
sure,
much lower than developed economies. I mean, it's a large pie for all players to go there and acquire. So that's not a very big concern.
Okay.
Point taken. So they're not falling because of competition. They're falling because the tax stop
the
given.
stop move is basically this thing.
Because the tax stop may not work anymore in their
my
favor.
only point is that the FDI thing is also not positive. I mean, if you're from a competition perspective, at the margin, 3% penetration, but the point is it's a small pie expected to go up, but right now it's 3%. So,
Absolutely.
But also
in which there will be foreign competition. But actually, the nature of the stocks that are in the red today clearly indicate those dependent on public spending are the ones that are falling.
Absolutely.
So if you look at the names, RVNL, IRCON, BEL, I mean defense budget cut down, JSW Energy, IRFC, all these are,
everything infra, defense, oil and gas, PSU, CPSE, everything is coming off. Energy, so that's the pack.
That big Capex push has not come through, and some of these stocks, by the way, had recovered from the recent bruising fall. They'd all started rallying in the run-up to the budget. So positioning was for a much bigger Capex announcement, which
maybe that the market is overestimating or overreacting to this. Because if you look at the revised budget, actually Capex has gone up by 10%. Because they brought it down from 11.11
from RE to B, it's gone up. From B to B, it's
so
flat.
if you look at it from RE to RE, the expansion last year also was only 10%, and this year also is 10%.
Which is what the economists have been saying, that in line with the nominal GDP growth, but perhaps the market was expecting for a bigger number.
Nimish is pointing out that Dixon is down 6-7%. It is indeed down. It was down 10%. It's down 7.5%. We had the Dixon management with us earlier in the morning, and we were talking to him about the PLI. There is, of course, electronics component PLI. which is a new thing, 25,000 crore allocation, which was expected. Maybe it'll come out of the outside of the budget. We don't know. But he was also saying that the earlier PLI, which finishes in FY26, maybe there is the mobile PLI basically, of which Dixon is a beneficiary. Maybe there's some extension, etc. Which I don't think there was really an expectation built into the price. It was something I think we asked him, so he said, well, we need it. But it's a big reaction, and there are many listed other players as well. We should just sort of run through those names: Keynes and Amber and so many others, right? I mean, Sirma, PG Electroplast, and we'll put all those names up for our viewers.
They're mostly down. Sirma is down about 2%. Keynes is down 0.5%. Not too much, but the price damage on Dixon is the highest at this point in time. Perhaps the stock market also didn't pay too much attention to what the CEA was saying. And then, our team was flashing this even yesterday, the commentary that came through. The indication this time actually was there in the economic survey. The government saying that the onus is now really on the private sector to fire up the animal spirits. But even having said that, I think that 10% increase in Capex is still what the economist was saying. Maybe the market wanted more. I think Shireen's coming in.
Surabhi, this is exactly what I've been pointing out. And I think Anantha Nageshwaran made it very clear that to continue to expect the government to do 20%, 25% is an unrealistic ask, especially when you're also asking the government then to provide for tax relief. I mean, revenue foregone of 1 lakh crore rupees on account of direct taxes. Where is the government going to make up all of that is a separate question altogether. But to expect that it will be the historical, what we've seen in the last few years, a 30% kind of increase as far as Capex is concerned. Even last year, the finance secretary had said, look, we have kind of reached a peak. We have reached a limit as far as how much we can do as far as government Capex is concerned. So the message has been sent out, not just in the economic survey yesterday, but was sent out in the previous budget itself by the budget makers who were here with us on the channel explaining how they were looking at this. But Mr. Chakrabarti, you wanted to make a quick point as well.
Yeah, quick
You're looking
point
at the numbers.
related to defense. It is RE number is roughly 4.56 and B number is 4.91. It's actually effectively an increase.
It's an increase. That's right. So that's a correction. There is an increase if you look at the RE number. So that's an increase as far as defense is concerned. I'm curious as to why we have Dixon, etc., selling off at this point in time. Because as I was pointing out again in the morning, we have Ashwini Vaishnav on record saying that the PLI component scheme is being worked on, and there was no guarantee that it would be part of the budget, but it's certainly something that consultations are taking place, so it can come post the budget, so the window is not shut, is the point that I'm trying to make. But is there something else? There was a whole host of issues related to customs duty rejig. I don't know whether that has anything to do with it or not, but perhaps it would be best to check with those companies directly. But that's the story as far as the markets are concerned. A quick final take before I let the two budget editors say goodbye. Ratin, we'll of course see you back in the evening as you digest more of the fine print, but on balance, your final headline.
The best thing that's happened here, and I'm not a Bihari, so I suppose the best thing that has happened here is for every Bihari in this country. And there's an election coming, so I understand. But I think is the promise to rationalize the tax code. What I'm very worried about, I'll come back with the exact numbers in the evening, is that the taxation system of India now is far more aggressive than it was yesterday. The proportion of corporate taxes haven't gone up much. Income taxes now kick in at 6 times the per capita income. And the revenue foregone from indirect taxes is almost zero next year, whereas the revenue foregone from direct taxes is 1 lakh crores, which essentially means that the Bombay Gymkhana has gained at the expense of the Aam Aadmi. And this is regrettable. I think I completely would like to endorse your point about capital expenditure. The government, to its credit, has very clearly said repeatedly that the heavy lifting on this front will ultimately have to be done with the private sector. And that has not yet been forthcoming, but there's only so much the government can do to raise Capex. I'm not so puzzled by the markets not responding warmly to this budget. Because again, if it's only the Bombay Gymkhana whose net disposable income is going to go up, that sector is already maxed out. We don't see new sources of demand coming here that would give a permanent boost to the growth rate of the next 150, 200 million who don't pay taxes. And therefore, probably the markets quite correctly have reacted with caution, unlike us consumers who are very excited about the next thing we'll buy or the next holiday we'll take with that 1 lakh crores. In terms of fiscal prudence, I think this budget has done a very skillful job. 1 lakh crores is not a large amount in budget making terms, as also attest to. However, it is the optics of doing that in personal income tax is absolutely massive, and that's a core support base of this government, and therefore this has definitely benefited them without too much cost to the exchequer. The government has stayed its course on fiscal consolidation, which is good. Let's see what's happened to expenditure, but that I'll tell you in the evening.
Okay, we'll hear back from you more on the expenditure side. Mr. Chakrabarti, a final take before I let you go.
One of the things which, since it came initially on the agriculture side, a very comprehensive scheme has come.
Yes.
Normally, they are all divided up. Something for irrigation, something for fertilizer, something for... It's a comprehensive scheme which has come up. I didn't get the name correctly, but it covers 100 districts and covers irrigation, markets, technology, everything. Though what one misses out on agriculture is it's supply side heavy. It also covers warehouses, rural warehouses.
Correct.
I really welcome it. However, on agriculture, we are still supply side heavy. It has to be, the market part. Perhaps it's still a work in progress. Everything cannot happen on the budget.
I have the name of the scheme, the Dhan Dhanya Krishi Yojana.
Dhan
Dhanya Krishi Yojana in partnership with states, which will cover 100 districts. And the finance minister saying 1.7 crore farmers will be benefited on account of that. So you're saying...
it's an excellent scheme. The other part is, second one is the part 2 of Swami. It was launched almost
the housing
4.5 years back for the stalled housing. If you recollect, all of us see a lot of shells of housing lying.
He's being modest, he designed it.
And there 15,000 crore additional has been provided. Of course, I wish this would of course come as a mix from both government as well as private sector. I hope 90% of it comes from private sector. Let's hope, because it depends upon how the rules and everything work out in this. It's a very well worked out scheme, has been successful. And, it's only the risk weights that RBI is going to attach to the assets which would be standard. That will decide. Third is on the regulation part. FSDC has been given the role on the financial regulations. Which means adding a lot of muscle in the finance ministry to the financial market division and other division to see that they can, because they're all very powerful regulators. To bring them, even though FM heads it, but somebody has to really act it hard. So a lot of lots of muscle has to be added there.
Lots of muscle.
To ensure that a direction gets taken, otherwise we'll miss woods for trees. And lastly, I'm very glad with the consolidation part, which is something I guess should, over a period of time, don't look at the market.
Yes, absolutely. Well, yes, consolidation, I think everyone concurs. That's positive. And two schemes that you specifically pointed out, the scheme for stalled housing, which gets an additional allocation, good move there. And of course, on the agriculture side, a more holistic approach with that Dhan Dhanya scheme. But Prashant, back to you. More information on what's happened to Dixon?
No, Shireen, as I was talking, I spoke with the Dixon management, and what they said is that if anything, actually what has come through is positive for their business. So, as the finance minister said, the basic customs duty on open cells has been reduced. They are setting up a display manufacturing capacity. We speak with them every quarter, and that's been something which the market is looking forward to. So, actually, it helps them. And they also said, the Dixon management has said that even for mobile parts, there are some reductions which have happened. And that is also actually positive. So, unaware whether stock was seeing a bit of a swoon, but you just see what's happening now. It's about 1,000-1,200 rupees recovery from the lows of the day on Dixon already. So it's actually almost flat now on Dixon. So I think, initial kind of knee-jerk reactions starting to get reversed. Even actually for insurance companies, you look at the price reaction, right? HDFC Life was down 7%. It's down 2.5%. Because, the dependence on the old regime is about 5 to 7% of individual new business new premium.
Prashant,
so a lot of it, there is excessive move, and then it kind of gets moderated.
I think what we have to keep in mind is today there isn't much volume. And perhaps that's why you're having these rather eccentric or volatile moves because the volume perhaps is not like on a normal day. Remember, it is a Saturday and foreign funds are not in the game. Well, actually, I want to look at it this way. Mr. Khara, you just correct me if I'm wrong. What could have gone to Capex 1 trillion less because, the increase is only 10%. And that 1 trillion actually is gone into the pockets of the taxpayer, right? Especially the small taxpayer, up to 12 lakh. Which means more people can spend, more people can take loans, retail loans, for instance. So, and normally the Reserve Bank's thinking is when fiscal deficit is kept under check, they are more courageous to cut rates because you don't want fiscal looseness and monetary looseness together. If the fisc is tight, normally the central bank cuts rates. This is their normal thinking. So, do you think that this is a boost for retail loans?
So I think, it is certainly a boost to the retail loans because when it comes to the ability to repay, they have got a better ability to repay. So that is a positive. But, when it comes to decisions relating to the policy rate cut, etc., they have got multiple other factors which they have to evaluate. And perhaps herein, even if the policy rate comes down, whether the interest rate structure will allow the reduction will be a function of the liquidity. If at all, unless and until liquidity improves, I think my apprehension is that the ability of the banks to cut the interest rate would be little constrained.
Fair point. Well, I agree with you. Liquidity also is something which the Reserve Bank has been giving. So hopefully going forward, we will see more such steps from them. Mr. Khara, thank you very much for being with us on such an important day. Sunita Reddy, the Managing Director at Apollo Hospitals, is also with us. Sunita, thank you very much for your time. Your first thoughts, there was a mention that medical tourism will be promoted. What have you made of the budget?
I think it's a fantastic budget because what is good for every Indian is good for healthcare. And the first part of it, of course, lowering of personal taxation is something that is going to put more disposable income in the hands of many more Indians. And moving on, this will give them access to health insurance products. The 100% FDI in insurance, while it might not show on the stock market, I see it as a very positive move because bringing in more liquidity will give insurance companies the ability to have higher risk pools and therefore create products that the middle class can access. We have seen private insurance and insurance products grow by 25% in the last 3 years. This is the best way to access corporate healthcare. So certainly a positive move. The second is the focus on oncology and cancer. The incidence of cancer is growing at far more than 7%, which is reported because it is not detected early. And with this focus, the dual focus, the first on creating daycare centers, they've mentioned 200 chemotherapy centers, which will cover all of the districts in the next 3 years. I think it's a great move. What needs to be done is to create a hub and spoke model and use AI and connectivity to make sure that we cover large populations. It would have been fantastic if we could have done this even on equipment that's needed for radiation. Currently, we pay between 28 to 36%. So a customs duty, a reduction on oncology treatment equipment would have been, very comprehensive for treatment of cancer patients. The third aspect is clearly the Heal in India, which you mentioned. And Heal in India, Heal for India, all of this is good. It's a $100 billion opportunity. And I believe that we have the capabilities in place. If you combine this with the skilling and the addition of 10,000 more medical seats, moving to 70,000, I think we can set up a very strong healthcare system that not only heals India, but heals for the rest of the world. And by doing so, like I said, it's a $100 billion opportunity. I think we will earn a foreign exchange, we will provide more jobs, and we will create a healthier India. So to me, the budget was definitely a step in the right direction.
Well, absolutely. And there was a mention of that in the speech as well, that promoting and enhancing medical tourism is also one of the focus areas for the government. By the way, look at the intraday charts of insurance stocks all over again. It's all happening right here because of a very sharp reversal playing out now on stocks like SBI Life, HDFC Life. Many of them have bounced back very significantly from the lows. Big uptick coming through as the market settles down and digests this. By the way, folks, I was doing rough back of the envelope calculations, trying to figure out how much do you save in this, new era of the new slab. So very, very rough. I mean, for someone who's earning 15 lakh rupees, my rough calculations show that in the earlier, this is the new concessional tax regime, but with the old tax slabs, that person would have had to pay 1,40,000 rupees in tax. Now the liability is coming down to about 1,05,000. So roughly speaking, 35,000 rupees of savings for someone who's earning 15 lakhs. Again, I'm not taking surcharge and cess, too many things going on at the same time. But roughly speaking, that's the saving that we're talking about.
No, the finance minister herself gave us those calculations. Those people earning 12 lakhs will save 80,000.
Yeah.
Those earning 18 lakhs will save 70,000.
Yeah.
And those earning 25 lakh will save 1,10,000.
Exactly, because for those who are earning 12 lakhs, the rebate itself is coming in.
Yes.
So it becomes nil. I mean, the rebate, which used to be only 7 lakhs, has now gone up to 12 lakh rupees with these new tax slabs. But anyway, it's anyone's guess. Now, where will this money be spent? Will it go in SIPs? Will it go to, buy new clothes? Stocks like Trent are surging about 7%. Will it go for travel and tourism and holiday? Or will it go in buying maybe better health covers? Because the market is worried on health insurance. And they're not being covered, with more people perhaps moving to the new regime. But there is generally higher disposable income. So could that benefit? Anyway, let me take that question to Nilesh Shah, who's joining in as well. Nilesh, the markets become so polarized today. All things economy are selling off and all things consumer are moving higher. But as the dust settles on the day and the budget documents, how do you think we are poised and, what next for a market that's been, hurting for several months now?
So while it is fashionable to say that market has been hurting for last 2 months, last 5-year return of market is 20% plus. So if you have given so much of profit, obviously there will be a consolidation or correction. This budget has clearly shifted focus from pure investment to also boost for urban consumption. And now that roti kapda makan is secured for most of the people, focus will be shifting to education, travel, entertainment, consumer durables and stuff like that. And that adjustment is happening in the market. More importantly, from a valuation point of view, capital good companies were pricing in price to vision ratio. So there is some amount of deceleration there. Consumer stocks, they normally trade at a higher valuation, but compared to their historically higher valuation, they were at a discount. So there is some amount of investor pulling over there. So we are seeing a distinct shift from infrastructure investments to consumption, both in the budget and hence in the market.
By the way, the market itself, it's not just life insurance stocks. The market itself is pulling back from the lows. Should keep that in mind. The Nifty's cut is around 60 to 67 odd points. That's the recovery that I'm talking about. Apart from life insurance, you've got stocks like Bajaj Finance moving higher. Of course, auto stocks are up. Aisha, for instance, is gaining more ground. And the Bank Nifty is also trying to reduce its losses.
You're right. Bank Nifty and mid-cap index were down about 1.5% at one point in time. Now down almost like 0.5%. So it's a fairly decent recovery that we've seen. Zia Modi, you've been with us for quite a bit. Thank you very much. But any last thoughts that you've heard, everyone? IFSC investments, anything from an investment point of view that you want to leave us with?
I think one will have to look at how the promotion of Nifty takes place, Lata. I think there will be a lot of movement there. I think one thing that I focused on was the concentration that the FM gave to the MSMEs, given that, they apparently constitute 36% of our manufacturing and 45% of our exports. And that led me to think about what is the boost she has given to the skilling sector? Because we have Indians, but we need to have employable Indians. And I think there also the government has tried to do what it can in skilling. And in addition, I don't think anyone has mentioned the AI part of it, where where the government has basically said that they're going to set aside a large amount to train people in AI for the Excellence Center. And I think that is one where both the country, the startups, and the foreign investment should converge well. And it's a new area for us. I think all in all, stable budget. No surprises from a foreign direct investment point of view. Some over-regulation by some regulators, which make it more difficult for FDIs and FPIs. But I'm assuming that will get sorted out at the back end. All in all, I thought it was fine.
Thank you. Thank you very much for that, for those wrapping up thoughts, Zia. And actually, under the FSDC also, they have, they are looking at an interregulatory committee, which perhaps will take out these extra compliance. Prashant, you wanted to say something? Go ahead, please. Yeah, Prashant, I think you're on mute.
Sorry, before Zia Modi goes, and unfortunately Kanabar is no longer there, but Nilesh Bhai is there. So a lot of things have been said about Gift City and the positives. Yeah. In fact, I would say, despite my overall very positive view on the budget, and in fact, I believe it's the best budget in a long time, it did nothing to address the core problem of Gift City, which is that under Section 9A of the Income Tax Act, which Nilesh Bhai is very familiar with now, fund managers like me or my peers who are seated in Singapore or Hong Kong or London, who are managing FII funds are effectively prevented from relocating to India, to Gift City. So you can relocate a few funds and make it like a mini Mauritius. But unless the fund managers are allowed to relocate, Gift City can't be made into the kind of city that our Honorable Prime Minister Modi ji has dreamt it to be. Just to complete the thought, metaphorically speaking, to grow a tree, it is not sufficient to have good soil, water, and sunlight. Most crucially, you need the seed. And the fund managers and investment teams, their investment managers are the crucial seeds to grow those trees, metaphorically speaking. So I must add that all this excitement around Gift City results into nothing but zero unless that issue is addressed.
I'm glad you raised that, Prashant, and I want to go to Ashok on this because we were debating and discussing this earlier as well. What clarifications come and have it on the relocation part. That and one more thing, Ashok, I remember this was a very big ask earlier. Basically, some of the non-bank units that are operating in GIFT, they wanted to get parity with the bank branches, the bank units in GIFT, in terms of issuing instruments like ODIs to overseas investors. That was a big ask. I don't know, I've not seen it in the fine print so far, but your thoughts on some of the issues that Prashant has also raised.
No, you're right. I mean, I have now seen the detailed fine print on IFSC, and the amendment required for Prashant to relocate to India is still missing. I mean, it goes back, his and my discussion goes back to many, many years when we first made this request to the government. But sorry, Prashant, there has not been an amendment, and the rules still remain rather rigid, which effectively means that existing funds operating out of Singapore, most of them are now from Singapore, not so much from Mauritius, are finding it difficult to relocate their fund managers. You can relocate the fund, but if you can't relocate the fund manager, then who's going to manage the fund? And I think sooner or later that change has to happen. Having said that, there is an interesting change that they have made in the Gift City rules, which is what they've said is, if there are two related companies and you have a treasury company located in the Gift City, historically, when there is a transfer of money from one related company to another related company by way of a loan, it's deemed to be dividend in the hands of the receiving company. What they have now clarified is that if the giving company is based out of Gift City, then any loan given by that company to a related company not based in Gift City is not subject to deemed dividend tax. So that's a very positive step forward in terms of enabling large corporates to set up their treasury business, certainly in Gift City, both domestic as well as global companies, without causing a deemed dividend tax. But to the point that was made by Prashant, we probably have to wait one more year
And what about ODIs, Ashok? What about ODIs? Because some of Nilesh Bhai's peers, for instance, I mean, Kotak has a unit. Many other Indian entities have set up non-bank units in GIFT, and they all want to be able to do the business on ODIs as well, which I think the tax benefits are restricted to the bank branches right now. Did you see anything there?
No, unfortunately, nothing there either.
Okay.
No change in law. But just two other points that I'd like to make is coming back to MSMEs and Zia's point that there is a lot of focus on the middle class. I think we are missing the point on the number of new opportunities in terms of increasing the limit for both micro enterprises as well as small enterprises. You know, I think a lot of microfinance companies and unsecured lending, stroke even secured lending businesses with small ticket loans have gone through an immense amount of stress in the last 6 months. You can see the delinquencies, you can see the challenges in collection, and therefore you can see that several companies are either reading under pressure if they're listed, or many that had filed for DRHP are not getting listed because of the environment. Increase of limits over there and providing insurance on a larger base, I think, is a very positive step. Government is giving an assurance to more and more lenders to say you can continue the business, and we know that there is some pressure at the lowest end of the economy, but we will cover you with insurance by increasing these limits. That's a very positive step.
Got it.
On insurance itself, on the FDI side, I think there is a very positive movement. I mean, we have 22 odd companies that
Mr.
are...
Vadva, sorry, I just wanted to, a point taken, I just wanted to clarify something, and I don't know if you've seen this. This is the point about bringing clarity in income on redemption of unit-linked insurance policy. And the wording is, it is proposed to clarify that the profit and gains from the redemption of unit-linked insurance policies to which exemption under Section 10D does not apply shall be charged to tax as capital gain. Is this, the way it is worded, does it look like it perhaps is retrospective? I mean, just your sense. Redemption from here on, basically.
Yeah, so effectively, if the redemption happens from today, it does not matter when you invested. Therefore, if you invested historically, but you redeem today, the language seems to suggest that it would be. I haven't read that still in the document. So my apologies that I can't provide you greater clarification. But if that's what it reads, then it means in some sense it's retroactive in nature, because past investments, if redeemed from today onwards or whenever the effective date is, shall become subject to tax.
So this is like what they did to debt funds last year when grandfathering was removed? Something similar?
Something similar.
Okay. I mean, that is... Zia, you want to comment quickly on this? Any thoughts? Okay. Okay, I think you're on mute, but I think you're saying you've not seen it.
I've not seen it.
I've not seen it. Okay, all right. We'll have to, I think, clarify with our with Sapna, reporter in Delhi, whether this is what they mean.
I'll have to run to the money control interview that I have right now.
Prashant, carry on. Let me just actually toss it across to Shireen now, who's at the CIA budget headquarters with the panel of guests there. Shireen, over to you.
Well, thanks very much, guys. Consumption is the theme that's playing out, and we're seeing a recovery even as far as the markets are concerned. The Sensex moving back into positive territory, but the man with the biggest smile, Sanjeev Puri, the president of the CII, as well as the chairman of ITC here with us. Sanjeev, many thanks for coming back into our CNBC-TV18 budget headquarters. Consumption, that middle class boost that was being asked of, the finance minister perhaps doing more than even what industry was expecting. What do you make of it?
Absolutely. I think the relief to the middle class is very welcome, and it's going to certainly provide impetus to consumption and therefore, contributing to the virtuous cycle of investment and employment. And this was much needed at this point of time. Of course, we do expect interest rates also to come off in February to reduce, and that should provide some further impetus. But the larger point of this also would be that this is the immediate relief. But a lot of sectors that have been touched upon in the economy are areas that employ, which are very labor intensive.
Right.
And the economic activity increasing in those areas will have larger impact on employment generation.
Footwear, toys, tourism, all being identified as sectors.
Even agriculture.
Yeah.
It has enough people, but
healthcare.
Income can improve. Income can improve. So all this itself actually feeds into the virtuous cycle of, therefore, consumption and investments. So there are measures for the immediate and measures that will also unfold over a period of time. So from that perspective, I think is a very, very, very positive.
But, you know, in terms of growth and in terms of providing that consumption boost, I mean, realistically, what are we talking about, given what the finance minister's already announced in the budget? As you pointed out in the morning, rural had picked up, urban was still suffering. Do you believe that this could alleviate the pain?
You see, you have, it will certainly provide some impetus. And there are multiple things that come together, right? For example, social security for gig workers. That will provide relief on medical expenses.
Yeah.
So a lot of pieces like that are there in the budget. And as I said, as employment comes in employment intensive sectors, that further provides boost. So we'll have to look at the full picture. This is one element of it.
One element of it. Rajiv Memani, let's look at that particular element as far as the tax cuts are concerned. Revenue foregone of 1 lakh crore rupees on the direct taxes side, 2,600 crores on the indirect tax side. But the signal that the government has sent out clearly saying that, look, we want to come in and provide a shoulder to the middle class. The big takeaway, we've of course got two big elections, Delhi right around the corner and Bihar. And, that's the message the government's sending out.
Yeah, I think, I think we've had pre-budget discussions. Everyone was expecting relief for the lower and middle income. But this extent of relief, I don't recollect, has been given 1 lakh crore in personal tax, which is almost, about 7 to 8% of the total personal tax collection that the government has. So I think it's a very significant relief. And overall, if you look at the overall theme from a tax standpoint, I think a lot of it is based on just simplification.
Right.
From the new income tax, 50% of the provisions coming down in the new income tax bill, that will be tabled next week. All the other things that they've also done, whether it's on TDS, TCS, all the other areas that have been laid out, a lot of that is on simplification. Also in continuity, no significant changes anywhere except addressing some, minor tweaks here and there. Unless if something is there in the final, then we don't know. But this government generally, whatever is on the table. IFSC always gets, they're trying to encourage and project IFSC more. That's there. And overall, the emphasis, whether you look at the economic survey or you look at the budget, this ease of doing business. And I think it is so important to unleash the spirits and to ensure that India achieves its full potential. I think that, setting up the committee, coming out with in the next 1 year, setting up some competitiveness among states, clearly recognizing that a lot of these things have to happen in states. I think that's a big change. And the pillars that they have identified, and focusing, some of which Sanjeev mentioned, focusing on those 4 or 5 pillars that are so critical for growth in the next 10, 15, 20 years, including nuclear power and changes in the act. I think that was quite good to hear.
Yeah, a target of 100 gigawatts as far as nuclear power is concerned. And remember, the IEA has said that 2025 is likely to be a breakout year when we talk about nuclear energy. So India getting into the ring as far as small modules are concerned. But Chandrajit Banerjee, what the finance minister has delivered on the consumption side, perhaps some disappointment on the Capex side. Clearly not on the lines of what industry was expecting or even hoping for, but it's in line with what the government has been saying. So on balance, the balance has been done and the balance has delivered?
Absolutely. Of course, we talked about a 25% more. There's no restriction to asks. But
no, clearly there isn't. Clearly there isn't.
But yes, this was expected, and one had thought about that. But if you really look at the type of spend that one sees on the Capex, which is still, quite reasonable in terms of if you compare it, what goes into rural infrastructure, even this about the states that 50-year interest-free, so all of that actually would help in crowding even the private sector, which has been called a laggard, so to say, for some time. And I see that coming in because we see a focus on a lot through that will come through the consumption demand. So all in all, not really any disappointment concerned with the Capex which the government has done, because it has done more than to offset through the consumption demand.
Done more than what was expected, certainly on the consumption side. Sunil Mujal, thanks very much for joining us. On balance, the big headlines, the big takeaways, what does the budget do to accelerate growth?
So actually the whole exercise, I think, was a balancing act between maintaining fiscal discipline, which the finance minister has put on herself over the last many years, at the same time figuring out a way to bring growth back in. So I think it's been done in multiple different ways. One is the building blocks, is on education, skilling, research, innovation, tech focus. That's very good. Second is picking specific sectors for high growth potential. Clean energy, deep tech, so the seeds, that's a massive area actually. What they've done in agriculture is a wide coverage. What I like is also focusing on some of the fundamentals, things like nutrition, things like the elderly, things like the farmer, small industry, export capability. So it's actually, I'm actually broadening the answer to your question, because I don't think it's only about that. It's not only about, growth is not something you can flick a switch and get tomorrow. But the tools have been put in place, and the point you were making just now about the higher liquidity in individuals and families' hands will either go towards savings or investments or consumption, and all three will do good. Even if you say it's about 1/3 each, roughly. So you're talking about 30,000 crores coming into consumption this year. So some of it will need to go because personal and family balance sheets were getting a bit upset because there was over leverage taking place on individuals. I think some of that will go to offset that, as companies and banks have done over the last 7 or 8 years. So I think we will come out better, healthier, cleaner. I do hope, unlike what CB is saying, I was hoping that the infra spend would have been higher, because this consumption takes a little bit of while for the virtuous cycle to kick in. Consumption can start, but consumption leading into production, leading into additional capacity, leading to jobs is a bit of a time lag. So that's one miss from my side. But I guess to be able to maintain the 4.8 instead of 4.9 at the FISC was a pretty magical number.
Oh, and it certainly was a surprise that came in there after having delivered on the kind of cuts that they delivered on. But Sanjeev Puri, let's talk about those untapped sectors where the government hopes to unlock potential. Tourism, this identifying 50 cities, PPP with states, PPP with industry as well. I'm not sure what the details are, but also including hotels as part of the infrastructure harmonization scheme that they're talking about. What did you make of that? And, a lot of actually the schemes that were talked about are work in progress. The actual operationalization still has to be detailed. So what do you take away from many of the announcements that came in?
See, first of all, many of the specific interventions that are there, you alluded to some in tourism. Then there are others, for example, in exports. I think the integrated approach, cross-ministerial approach, I think is absolutely the one that is required, because in the morning also we spoke about some of the issues that have to be dealt with, which requires a cross-ministerial approach. And something CI has also been talking about, having an integrated approach. Looking at setting up this committee on ease of doing business. And taking an integrated and focused approach on agriculture, 100 districts, all-round development. Taking an integrated approach on rural, the non-farm development. Really sending some development and resilience hubs for rural areas. So these are very fine ideas, very good ideas, and certainly will unlock the potential in many areas. Creating a framework for GCCs. GCCs are already, doing well in India.
And massive job creators.
Massive job creation, and the world has demographic challenge. So it's a great opportunity for India, and to provide impetus to it, to make some, today it's happening on its own, without really any impetus or for specific interventions. So right now, to create a facilitative framework for this, I think it's going to provide further impetus to it. Then the whole idea about the strong point of reforms and collaborating with states. I think this will provide a lot of impetus, because a lot of reforms now need to be done at the state level, right? So a lot of the right things are there.
Yeah.
And I think what I'm very happy to note also is that there is a lot of clarity on the mechanisms that will be used to do it. It is not just a statement without an institutional mechanism.
Sure. Rajiv Memani, the big headline for you as I say goodbye, at least as part of this session, but the big headline that you take away from what the finance minister has delivered.
I would say identifying the critical growth drivers for Viksit Bharat, ensuring that there is, as he rightly said, that there is a focused approach, interministerial approach for that, including ensuring that there is good state-to-state collaboration and identifying all the levers, even AI, deep tech, global value chains. So at least the thought process of growth, the growth levers are very clear, and how you take that through. Now the main thing is, how these committees come, how the execution happens, and what changes on the ground.
It comes down to execution. CB.
So adding to what Rajiv said, I would think the National Manufacturing Mission. That's going to be very critical, because that's going to really cut across. And secondly, the element of trust, the Jan Vishwas Bill 2.0, that again is a very, very big takeaway for me.
Okay, Mr. Munjal, final word.
So the setting up of a group to review all rules, regulations de novo, I think is one of the most critical things which has not got enough airtime from any of you. Because for a long time, we've all been cribbing about excessive red tape. We've tinkered with the laws and rules for 50 plus years. We've scrapped many, we've decriminalized many, but it's not enough, because they were designed over 100 years ago. I think this is a fantastic move, other than making things easier for industry, accelerating M&A, and there's a whole bunch of things on that front, which I think are quite welcome.
Well, we'll have to wait at least a year for that committee to deliver its verdict on what will be axed, what will need to go, but a clear message being sent out by the budget. Mr. Munjal, CB, Rajiv Memani, Sanjeev Puri, appreciate you joining us here on the CNBC-TV18 budget headquarters as we digest what the budget will do in terms of growth and how it will propel the needle of the economy. We are going to take a break. We haven't taken one in a very long time. We're back in a moment with more. We leave you with where the markets are and come back for closing. Stay with us.